So, very good evening, students. Very good evening to all of you. So, students, Radha, Kanaya, Lakshmi, very good evening, students. So, students, we will start then today, probably with I think the demerger is what Radha was left, isn't it? That was one. And then that 25% threshold that you have already identified that in section number 70, we'll discuss those aspects as well. And then we will move to our next segment. And the next segment, students, would be about the taxation of the real estate transaction. If you see, students, your capital gains as a head, see how logically you should now revise. Now, at the end of the day, students, you also have to revise, isn't it? If you see, students, the entire capital gains head, other than the discussion of the some general provision, which is applicable for everything, like what is the transfer, what is the definition of a capital asset, the property held by the SSE, isn't it? And thereafter the computation of capital gains, then the special rate of tax. Those things are applicable generally to all the whatever be the situation of the capital gains. You will have to encounter these things. But if you see very closely, students, now you would realize and you'll appreciate that the entire head of capital gains, technically speaking, will result into mainly the three aspects. One is the entire general provision that we have been discussing from time to time. The second aspect, friends, is all about the business restructuring that we have been doing it up till now. And the third, then the major aspect, friends, is about the real estate transaction. Real estate transaction. If you see and you'll agree, right till that exemption of 52 series, remember that, friends, 54 series, that exemption was there. And one way or the other, there was some sort of a correction with the real estate. 54, 54 EC, 54F, if you can recall faintly, if you can recall your inter-CA in that context. The same thing, students, you will have it over here also. 82, the exemption here starts from 82. So whenever now should you revise it, you should always revise it this particular three compartment in this context. And then the last one, students, there is a partnership assessment. For partnership, students, there is a dedicated provision. A dedicated provision in the context of a partnership firm. If you can divide the entire things in this four structure, students, you have done your capital gain. This is an intelligent way of dealing with it. And when you do your practice also, at that point of time also, you will have to keep grappling with these restructuring exercise, or for that matter, students, the real estate transactions. What are the capital gains implications? So on and so forth. So now, students, let's first come back to our discussion that we were doing it in this context. Now, students, I will be revising the last session based on the new particular structure that we have already based on the structure that we have already discussed in the last lecture. So one way or the other, this would also be a revision for all of us. And by doing that revision, we will be unfolding the new particular aspect of section 70, what has been given to us. Just a second, students. Let me share the screen first to all of you. Now, students, if you all see over here, please have a look. So this is one thing, students, that we were discussing last lecture. Just have a look, students, over here. Students, over here now. Transaction which is not regarded a as a transfer. So part A, students, this particular part A, the family estate, I've told you about this particular part, the family or the estate or the group reorganization, the holding and subsidiary or the amalgamation is what primary students we have seen. The family arrangement, group reorganization and corporate restructuring is what students we have been focusing on. Apart from that, students, here, like in the case of this one, rather you have asked a question on the amalgamation in respect of a foreign company, foreign amalgamation. Now, just this, although has to do with something about the international taxation, generally this is an amalgamation of two foreign companies. Students, generally, this is the amalgamation of two foreign companies. Then what happens over here? Students, what happens over here? In the case of the amalgamation between the two foreign companies, students, what happens is that, say, one foreign company is already holding the shares of an Indian company. Okay, say a company in USA is holding a share of, say, Tata Sons. That company in USA is getting amalgamated with another company in UK. Okay, so what will happen? All the assets of that US company will become the assets of that UK company. In that asset, one of the asset is the shares held by the shares held in the Indian company. So therefore, one can say and definitely argue that there is a capital gains for that US company to the extent of that shares which is held in the Indian company. To that extent, there is a capital gains which has been accrued in India. Why? Because the assets belong to India. And if the assets belong to India, so therefore, in that case, or the asset is situated in India, the correct particular phrase, assets are situated in India. So whatever is the transfer that has taken place in respect of the assets of the US company, in respect of that transfer, some transfer which relates to the Indian asset, we can say that the capital gains has accrued in India, isn't it? Now, just imagine, students, for this particular part, the government, in fact, require this scenario. See over here. What exactly they have said that if the two foreign companies are getting amalgamated and in the process some of the assets, namely the shares of an Indian companies are getting transferred by one foreign company to the other foreign company, then we will consider this as a non-taxable transfer. What we are going to consider this as a non-taxable transfer, students, in this case. So it says not a taxable transfer under section 70. The only conditions to be satisfied is the only condition that has to be satisfied is what? That at least there has to be a 25%, that has to be a 25% shareholder continuity that is required. 25% in value. Remember Radha Karaya, all the students recall the last lecture we have seen when we were doing the amalgamation. What about the amalgamation between the two Indian company? What was the threshold? Please recall. What was the threshold requirement? If it was to be considered as a non-taxable transfer, the first
Three-fourth of the value.
three-fourth of the value, students, isn't it? It was a three-fourth of the value of the shareholders in the amalgamating company shall continue to remain the shareholders of the amalgamated company. And also the amalgamated company has to be an Indian company. If and only if the conditions are satisfied, that the transfer will not be considered as a taxable transfer is what we all have discussed and finally have concluded. I hope that all of you are clear with this one, students. Every one of you. Perfect. So this is what is required, students. But in the case of the foreign amalgamation, the requirement, students, is that of only 25% in the value. One may say, but sir, why is it the difference? In India, sorry, for the Indian amalgamation, we say three-fourth of the value is what is required for the purpose of the exemption under Section 70 when it comes to amalgamation between the two foreign companies in which one in which the transferor foreign company is holding the shares of the Indian company, then the exemption would be applicable only if what? The exemption will be applicable only if 25% in value of the foreign amalgamation, the 25% in the value of the shareholders of the amalgamating foreign company continue to remain the shareholders of the amalgamated foreign company. So the threshold in their domestic law, students, is less. Generally, the thresholds in their domestic law has been less. So if their threshold in their domestic law has been less, students, so we cannot be very demanding that we don't care about your domestic law. In Indian law, you have to make it 3-4%. See, you cannot dictate the amalgamation, isn't it? The amalgamation happens for a commercial consideration. Tax angle is only a byproduct. That is what we will say. So if the foreign legislation generally recognizes 25% value of the share commonality of the shareholders, 25% in value of the common shareholders is what they recognize. So we also in our domestic in our tax law also we have given that recognition. So therefore, when the two foreign companies are amalgamating, then the exemption under 70 is applicable if there is a common shareholders of how much, students? At least 25% in value. Is that clear to all of you, students? Now this part, students, the next foreign amalgamation 71H, you will learn only when you do international taxation, non-resident taxation part 1. At that point of time only, students, you are going to appreciate this particular nuances. At this stage, it is very premature for you to enter into this regime. With that, students, now before I do demerger, students, before I do demerger, some section 70, students, that I will pick it up right now, only for the sake of revision. Let's have a look, students. Only for the sake of revision, students, let's have a look. Students, over here, part B, if you see over here, sectorial, conversion, and other specified transaction. I will pick up some sectorial, students. You can just ignore it for the time being. As and when it will come, that will get addressed. Just pick up this particular part, students. I'll just take across right now whatever is eligible for you to recall it. Students, preference shares. Can you see that? Take this example, students, where you were the shareholder. Students, year zero, year zero, you acquired a preference shares. Acquired preference shares. You all have acquired the preference shares. So preference shares has been acquired? Yes. In this context, preference shares has been acquired. And say, for example, students, say at rupees 100. This is year zero. Now what happens, students, over here? Say year number one. These are convertible preference shares, students. So preference shares got convertible, students, converted to equity shares. This got convertible, students, to equity shares. Fine, students. And then say after 1.5 years, they were listed equity shares, students, by the way. Say year 1.5. Year 1.5 in this case. So from 0 to 1.5, year 1.5, we'll say that equity shares which was listed has been transferred. Equity shares which are listed have been transferred. So students, now the question to all of you is this. Students, now the question to all of you is this. What is the question, students? The question is that, first, what about the conversion of, students, what is the conversion of the preference into equity shareholding? What is the conversion of the preference into equity shareholding? Is it a taxable transfer or not, is my question to all of you. Conversion of preference to equity in that context. So 71ZB, can you see this one, students? 71ZB. This section categorically states that any conversion from a preference to equity, that is not a taxable transfer. So 71, you just forget the the clause number, students, you can just remember 71. That much more is more than enough. And in the last to last session, towards the end, we were having the opportunity to discuss this section 70 also quite extensively. So just this much is enough for all of you. Okay. 71. In this, what we will say, that such conversion is covered under section 71, and accordingly it is not a taxable transfer. Please be careful, students, I'm telling you. Here the SSC is not monetizing every particular section 70. You have seen a theme, students. Do you know what is a theme? You have not yet monetized your asset. Do you all agree, students? Up till now, whatever section 70 that we are referring, where was the monetization that has happened? Monetization hasn't happened. Be it the case of the amalgamation between the companies, or amalgamation within the shareholder level, where the shareholder of the amalgamating company is exchanging the shares of the amalgamated company. That is what is happening. Or for that matter, your first section 70, the asset was received on account of gift, will, inheritance, succession, all that. Where is the question of monetization? They are not monetizing the asset. So this becomes a central theme, students. Because you are not monetizing it, and just these are the transaction which the government provides a recognition that they are postponing the, what they are doing, students? They are postponing the charge itself. The chargeability is getting postponed under section 70. And what they say, such transfers are not a taxable transfer. And if it is not a taxable transfer, the chargeability does not get attracted in that leg of transaction. The chargeability does not get attracted in that leg of transaction. So subsequently, when the assets are being sold, that is a time even the legislature or the lawmaker recognizes the fact that this is the time when the assessee has earned real value or the real gain. And because the assessee has got a real gain, that the computation will begin, or the chargeability is attracted. And if chargeability is attracted, the computation will be done in that particular point of time. But then, students, we have discussed last time also, and I'm going to repeat again this thing. Students, tell me then, this is covered under section 71. Okay. So when you are, students, subsequently, when you are transferring the asset, so what you are transferring now? Equity shares which are listed in a recognized stock exchange. Now be careful, students. If it is the equity shares which are listed, then it becomes very important for us to distinguish, to know. It is very important for us students to know that it is short term or long term. So Radha or Kanaya, tell me whether it is short term or long term in this case.
Sir, it is long term
And why is it so? Are you doing the
because it
clubbing of?
is
Yeah, please say.
no, because it is greater than 12 months and it is listed securities.
Okay, listed securities. So therefore, now, which means that, what, to be very precise, are you also doing the clubbing of this particular period? That is the period when the securities were in the form of preference shares. Whether that period also needs to be clubbed or to be considered? Answer is yes. Isn't it? That is the reason why you have not only considered the period when the securities were held as equity shares, but the previous particular period when the securities were held as a preference shares, that period also has to be considered. Isn't it? So, yes, you are correct. You have done the clubbing of period of holding, and by virtue of that, the securities are held for more than 12 months, and accordingly, it is a long term capital asset. This is such an important discussion, students. Do you know why? If supposingly you don't do this clubbing of period of holding, then what you will have a short term capital asset. You will have a short term capital asset, and if it is a short term capital asset, you will have a short term capital gains, and then you will tax at under section, which section? 196. 196, 20%. 196, 20%. The short term. But now what you are saying, sir, it is long term. And the moment you say long term now, students, please tell me, the moment you say long term, where it goes? Under section 198. And with 198, the rate becomes 12.5%. And that 12.5%, that too in excess of 1 lakh 25,000. See the difference? You miss this concept, students. You will end up having a completely a wrong particular answer. Do you all appreciate this particular point, students? One last thing, students, as an examination note, just keep in mind, and if it is possible for you to take a note in your notebook also, please do that. Please be very careful whether it is a conversion of preference shares into equity or the question is about redemption of preference shares. Students, if it is a redemption of preference shares, Section 70 does not apply. Why? He already has redeemed his preference shares. He has monetized the amount. So he already has got the amount with himself. He has monetized it. Redemption of preference shares is considered as a transfer. Anarkali Sarabhai Supreme Court. And we've discussed this point also earlier. Under Section 67(1), it is generally charged and accordingly it is taxable. But if it is a conversion, then is it a taxable transfer? No, covered under Section 71. And I have already given you a theme. How do you remember 70 series? Just keep this in mind that there is monetization of the asset is not happening. In for which these cases for which the government is showing an extra mercy or benevolency, may I say in that way, in these cases there is no monetization that is taking place, and that is the reason why, students, we find Section 70 comes as a rescue. But don't, please be careful when there would be a subsequent transfer. At the time of subsequent transfer, the cost will be backdated. The cost will be backdated, and also the period of holding also will be considered from that particular backdate. Which back date? The date when the cost was being taken. With that, students, now all the other things, sole proprietorship section, students, I hope that all of you would have you gone through that? The homework which I gave you to all of you. Sole proprietorship, partnership and all. Those things. Students, now there are certain things like business trust and all. All these students will come in a specific topic. So there are now elements which are left after this, whatever is left, students, will come in the topic itself. So obviously those things we are going to touch upon in the respective topics as and when it will come. With that now, students, I'm coming to our last category, and which is that demerger. Students, last category, demerger. Yogendra, perfect. Yogendra, yeah, perfect. Let's start on the demerger particular part. So students, in the demerger, as you may be aware, I gave us some bit of a hint to all of you in the last session, and I'm extending that thing again. Students, what happens in the case of a demerger? Demerger, students, probably what happens in this context? We say, students, it's like a spin-off. Spin-off means, I, let's take an example, Tata Sons. Tata Sons was the original flagship company and is the original flagship company. In Tata Sons, students, there were many particular unit and divisions. Like we had earlier at the very original point, Tata Motors, Tata Chemicals, TCS, everything was a part of this flagship company, Tata Sons. That is exactly what it was. But then what they realized, so Tata Homes, for that matter, Tata Group probably has got many undertakings. So these particular flagship company, these particular undertakings were a part of the flagship company, and which was Tata Sons. So now in this case, say in this it was Tata Motors, okay, and other particular case say Tata Chemicals. Now what happened, students? Generally, I'll tell you practically so that you people are clear in your thought process. So originally there is a common management which is given to all the group companies. All the common management which is given to all the undertakings in that group company. There is a common management. But then suddenly when they see that some of the division has a very faster growth rate, some of the division has a very faster growth rate and all, and it is showing lot of promise, then it would be something not doing a justice to that division if it continues to be under the common management or the common umbrella, isn't it? Because then their growth will get hampered because they require 100% time and attention, whereas now because of the common management and common control, that the time and attention that it deserves is not being given to them. That is the reason why students, the government then choose to do what? They try to spin off. Spin off means remove that particular undertaking from this flagship company and make this as an independent unit or independent company. And now with that particular unit becoming an independent company, students, you know what is going to happen. What is going to happen, students? Tell me. There is this group company. Now a division came out from that group company, and that division will be separately, would be having a independent management, independent directors of that particular division, which will now be considered as a distinct company. Distinct company. Okay, so that is what will happen. Now, please understand, students, over here, please understand in this particular context, be careful. Students, be careful on this particular part. Just a second. Huh? What happens now? Say Tata Motors primarily now has become a Tata Motors, or Tata Chemicals has become Tata Chemicals Limited. They will have the assets will be there in the division. The division will also have its liability, isn't it? Now, if supposingly, students, be careful. If supposingly there is a demerger is taking place where this division is taken out and it is making a separate entity altogether, say Tata Chemicals Limited, and the demerger, students, this would be a demerger. Now, demerger has its own condition. And what is the condition, students? If at all it would be considered as a tax neutral demerger. Tax neutral means there would not be any tax implication on the demerger or at the time of demerger, then certain conditions has to be satisfied. That is what you are going to read now in section number 70. This is similar to, students, what you have learned in amalgamation. So far as the assets was concerned, students, please tell me, these assets belong to Tata Sun. Although the assets were in the division, Tata Motors division, but it belonged to Tata Sons. Now what happens? All the assets of that division now will become the assets of that company. Which company? The new company. What is the name of the new company? Tata Chemicals Limited. Earlier it was a division of Tata Sons. Now it has become a company altogether. So all the assets of the division will now become the assets of that company. So is also the case with the liabilities of that division will now be the liability of the company. That is what will be considered. So these are the basic conditions. And if you satisfy these conditions, then the transfer that has taken place from Tata Sons to Tata Chemicals, that will not be considered as a taxable transfer. Obviously, students, the same common condition should remain, which we have seen in the case of amalgamation, which we have seen in the case of holding and subsidiary transfer. And that common condition is that the transferor company, students, should be what? The receiving company, that is a transferee company, students, should be an Indian company. The receiving company, that is a transferee company, students, should be an Indian company. That is a common condition that has remained throughout. And I have also given you the logic why they are so much emphasizing that the transferee company should be an Indian company. In the last lecture or last to last lecture, I already told you why they are emphasizing on this particular condition. So, students, that is it. Now, students, there are certain issues or the tax issue that will arise. Two issues will arise, one at the shareholder level and another at the company level. Shareholder level. Let's talk about the shareholder first. Students, I am a shareholder of Tata Sons. I am a shareholder of Tata Sons. Okay. Now what happens after the demerger, students? After the demerger, what happens, students? Suddenly, I will also I have acquired. I am originally the shareholder of Tata Sons. I have acquired the shares of Tata Sons, say of rupees 100. At rupees 100, I have acquired the shares of Tata Sons. Thereafter, students, what happens? Because of demerger, I also become the shareholder of Tata Chemicals. Why? I will also get the shares of the Tata Chemicals also. Isn't it? There will not be any new shareholders. You don't expect. Obviously, there could be some shares would be given outside. That is possible. But those who were the shareholder of Tata Sons will become the shareholder of Tata Chemicals. So I was the shareholder of Tata Sons. I became the shareholder of Tata Chemicals now. And now I'm holding both the shares. One of Tata Sons, another of Tata Chemicals. Isn't it? Now you will say, sir, Tata Chemicals, you just happen to get the shares. You have not paid anything for it. You paid originally for Tata Sons. Say rupees 100, you paid to acquire the shares of Tata Sons. So technically speaking, so far the shares of Tata Chemicals is concerned, you have not paid anything. The cost has to be zero. Yes, students. That way, if you are trying to say that I received it for free, then one may appreciate your argument that yes, it is zero, but it is not. Why? Because when I acquired the shares of Tata Sons, in that Tata Sons, the division which is Tata Motors was part of it. So that 100 value, some portion of 100 value has represented what? The value of that Tata Motors. Some portion of that 100 value of my cost has represented the value of Tata Motors or Tata Chemicals, whatever division has been demerged now. So, therefore, now from my original cost, I will then do the attribution. Attribution means some portion of the cost belongs to that other company whose shares I received after demerger or at the time of demerger, whose shares I received at the time of demerger. So some portion of my original cost has to be attributable to that particular company. Is that point clear to all of you students? Everyone. If you have any doubts, please let me know because then we are going to start with this particular provision and after the provision, we are going to solve some questions. Quickly, students, any query that you
Sir,
may
what
have,
is the basis of attribution?
and because that is the logical part in this
Yeah,
case.
like it is pro rata basis on the
That we'll see,
like.
that is there in the provision, but I want to try to make the concept clear. Is the conceptual part clear before we enter
Yes,
into the
sir.
provision
Concept
part?
is clear. Yes, sir.
Sir,
Aleti,
sir, good evening, sir.
good evening. Kanaya,
Sir,
say.
I have a doubt, sir. Like, in case of company, sir, who is transferring the share, in 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 case of demerger, so they are getting exemption under Section 71, right? And
Yeah.
in case of shareholders, sir, who are getting the share of a new company or demerged company, whether 71 apply in that situation also, or
For
whether the redemption portion will be taxable as capital gains.
for the shareholder, you're talking about it.
Yes, yes, sir.
So shareholders, technically speaking, what happens for them? Also, the similar part is there. There is nothing which is taxable to them at the time of demerger. Remember one thing, student. Amalgamation, if it satisfies the condition. Demerger, if it satisfies the condition. Amalgamation, demerger, and the succession of the firm into a company and the conversion of private company into LLP. If they satisfy the condition, now I'm giving you a thumb rule. The thumb rule is that it is tax neutral both at the company's level or at the entity's level as well as at the shareholder level. Which therefore means at the time of amalgamation, demerger, succession, conversion, neither the entity nor the shareholders of that entity will be liable for any tax provided the conditions are satisfied. That is it. So it's tax neutral at both the levels, entity as well as a shareholder.
Okay, sir. Okay,
Okay.
thanks, sir.
Sir, are we going to discuss about the succession and conversion? I have already read the specific section fully.
Yeah.
Like because conversion into LLP, so it has certain limits of 60 lakhs and 5 crores. That is the assets. So
Yeah.
are we going to discuss that or like it was
If there
self?
are any doubts, then you let me know in that on that particular context. If there
Sure,
are
I
any
will.
queries.
Yeah, at the end of the session, I will ask them.
Okay, yeah, yeah. Okay.
Okay, sir.
We'll just now go to the provision part. Students, let's come to the provision. Students, let's come to the provision part. Demerger. And so there is a practical question also. This practical question, you just mark it because this is an examination question. One of the comprehensive examination question, although there were many of the questions of your past year, but this happens to be very comprehensive question. Okay, by the way, slum sale, you people have solved it or not this question? I have solved one question with you, my self-made question. For practice, I gave you this. Did you all happen to solve this one? Got an opportunity to solve? Students keep solving also. Students, it's important that what will happen is that one question that we are doing this thing, similar question. I'm not giving you new question, students. These are more or less a similar question. So whenever you get opportunity to solve similar questions, as a matter of practice, when you tally the answer, you'll get a confidence that yes, what we have learned, that is getting ratified. Okay, so please don't skip that particular part. And the best part is that when the sessions are going on, students, at that time only, if it is possible for you to stretch it up and finish it off, it will be very helpful. Because obviously, I understand that the articleship pressure and every other particular pressure is there. But still, if it is possible, why I'm telling you, because of the fact it will take less time at that point of time for you to execute a solution. But say after some days or some months, if you look into it, the same question, I'm not saying that you will not be in a position to do it, but it will take some more time. So therefore, you save time. So it's all about, I told you students in my initial class also, CA final is all about the timing. Nothing counts more than the timing part. It doesn't matter a student's taking a 3 months or study leave, 1 month study leave, 2.5 months study leave. Students, I have seen many of the cases, I'm telling you, in the last 20 years or so. Probably I've seen thousands of particular students and all. And I tell you that these things becomes very subjective. Probably. It's all about at what time that person has done what. That is a game changer. At what time he has done what. That ultimately defines your CA final. This is what the CA final is all about, primarily. So it's all about the sheer timing, students, that plays out, primarily, for getting into that excellence. CA final is all about the excellence. Excellence is all about what? Knowing what to do and when to do. That is the excellence. And students, you need to crack this code and you need to have that, you need to be at the top of your game. That is something that you just cannot afford at this particular point of time of your chartered accountancy course. Be at the top of your game. When I say be at the top of your game, does not imply relatively only on that content part, also about the timing part, students, which I'm emphasizing it right from my initial lectures because that is what it's all about at the end of the day. And this is what it all will matter. In the hindsight, when you see, you will know that I am this because I have done this at that moment. This is, you will travel backwards in your life. You'll always know that because I did that at that point of time, that I am today this. This is the thing that will ultimately matters. Let's come to on the demerger part. Definition and statutory conditions. Property. Requirement is all the property of the undertaking immediately before the demerger becomes property of the resulting company. All. Okay. Liabilities. All liabilities relatable to the undertakings becomes liability of the resulting company. That is for liability. So if you see the definitions are same. If you talk about amalgamation also, But yeah, in amalgamation, the entire entity was being amalgamated, was merged with the other entity. Here, it's only about the division. Now, the book value condition. Property and liabilities are transferred at value appearing in the books immediately before the demerger, subject to the statutory index exception. Proportionate share issued. Obviously, students. Resulting company issues shares to the shareholders of the demerged company on the proportionate basis. It has to receive on proportionate basis. All of you will agree? Yes. It has to receive on proportionate basis, students. All of you will agree? Yes. The three-fourth shareholder continuity, the same thing of amalgamation, the same thing has continued over here also. And what is that? At least three-fourth of the shareholder of this Tata Sons should become the shareholders of what? Of the Tata Chemicals. Three-fourth in value, students, in value. Going concern, and this, that is it. Now, students, this is what it is at the end of the day. So this precisely you will relate it, sir. This is more like the amalgamation condition. Yes, students, you're right. More or less like a amalgamation condition. Now let's come to the tax provision now. What is the tax consequence? Demerged company. Now, students, there are two companies now. After demerger, there is two companies. In the language of demerger, you will say the old company as a demerged company, and the new company would be referred as a resulting company. The new company will be referred as what? As a resulting company. So the demerged company transfers capital asset to Indian resulting company. Provision is 71J. Is it a transfer? No. Resulting, so it's only one condition in this case. Only in this particular case. What is the condition is what, students? Indian resulting company. Did you notice this particular part? It was Indian resulting company. Why, students? Now, Kanaya, in your case, you said, no, sir, I am receiving the shares of the resulting company as a shareholder. Will I be subject to any capital gains on the extinguishment of my right in that division? And the answer is no, 71K. This is your answer, Kanaya. But just remember the broader logic which I told you. The tax neutrality. What is the word I'm using, students? The tax neutrality is applicable at the entity level as well as at the shareholder level. Provided you satisfy the conditions. What are the conditions? That is what we are seeing. These conditions we have read just now. So satisfy these conditions, then you will achieve tax neutrality. What is tax neutrality? Not a taxable transfer. This transactions is not a taxable transfer. So even the shareholder, see here, the resulting company issues or transfers shares to shareholders in consideration of demerger. So because of demerger that the resulting company is issuing or transferring the shares to the shareholder. Please say what happens over here. Is it a transfer? Not regarded as transfer. Again 71K. After this, students, cost of resulting company shares. Cost of resulting company shares. Section 73(1), table serial number 14. Now, obviously, I told you now, both resulting company. Now, I had acquired the shares of only Tata Sons. Students, I acquired the shares of only Tata Sons, 100. Now, from that 100, I will have that proportionate concept. Proportionate means some portion of 100 will relate to Tata Chemicals, the resulting company, and the balance would be of the old company, which is Tata Sons. So, how much of the portion will relate to the resulting company? In my example, was Tata Chemicals. How much is the portion? Let's have a look. Cost of the resulting company shares, students. Cost of the resulting company shares. Can you see that? Original shares cost. In my example, students, it was how much? 100. In my example, students, it was 100. Original share cost 100 into net book value of the asset transferred. So book value of the asset transferred from the division to the resulting company. So whatever is the book value of the asset of the division, that will become the numerator. Numerator. So division divided by the net worth of the demerged company immediately before demerger. Now, students, the question is, be careful, students. The question to all of you is, Here, just you may take a note of this particular part. Generally, they may not, but you should always keep a note. Students, here the net worth is the capital approach. There are two types of arriving at net worth. I hope that you people are aware. In accountancy, you may have learned that there are two particular ways of determining the net worth. And what is that two types? One is the net asset approach, wherein the assets minus the outside liability, that will give you the net worth. And another is a capital approach. Another is what? The capital approach. The share capital and the reserves. That also results into net worth. So here, students, here it is the capital approach that you have to take. The net worth for the purpose of determining the proportion which will apply on the original cost. And what you are going to get by applying this proportion on the original cost, what you are going to get? You are going to get how much of the cost is attributable to the resulting company. How much of the cost of my shares is attributable to the resulting company. That is the objective. By doing this, what exactly you are doing it, students, over here? Tell me what exactly you are getting it. Think logically, not just as a formula. By net book value of the asset, transferred, of the asset which is transferred, divided by what? Divided by the net worth. Net worth of net worth before demerger. So by doing this, tell me one thing. By doing this, what exactly you're getting? A proportion of the assets of the division vis-a-vis the entire net worth of that old company. So this proportion. So net book value of the asset transfer divided by the net worth of that old company before division and apply on my actual cost of the entire shares which I have held. In my example, it was 100. So this will give you the proportion of how much of the my actual cost relates to the division, which is now the resulting company. This will therefore will give you what? The cost of the shares of the resulting company. Now, once say for example this formula, by applying this formula, it comes to say 30. By applying this formula, the amount comes to 30. So what happens now, students? I get the cost of shares of the resulting company, which is 30. Now, if this is 30, now tell me how much balance is left for the old company, 70. So 70 will become the cost of that old company. Cost of that old company, cost of the shares of the old company. Is that point clear to all of your students? This proportion method. We will solve this particular question also over here. Please come further. Now, students, other than that, other things students will also come into picture. Residual cost of the demerged company. So old company, what is the balance cost now? 70 in my example. So 70 would be the example. What is the cost by applying the formula? What is the cost by applying that formula for the resulting company shares? 30. So how much is balance left for the old company? 70. How much is the cost left for the old company, which is 70? I hope that every one of you are clear with this one. Fine with. Now, sort of the same thing, loss or UAD, which is relatable. That same thing in amalgamation also, should we have referred the same thing? Loss and the UAD of the predecessor company. Can that be carried forward by the successor? The answer is yes. Same is loss or UAD relatable to the division. That will be carried forward, students. That will be carried forward to the successor resulting company. Successor resulting company. Students, let's have a look to this one now. That this was an examination question, if I'm not wrong. Yeah, this is an examination question. SS Private Limited, an Indian company with two undertakings, engaged in manufacture of cement and steel, transfers its cement division to RV Private Limited. So students, be careful. Now, just read this one, students, up till here. See, let's read this one together and then I'll ask you some question. SS Private Limited, an Indian company with two undertakings, engage in manufacture of cement and steel, transfers its cement division to RV Private Limited. an Indian company by way of a qualifying demerger in January 2027. Now, students, if you recall in the last class, be careful what I'm saying now. I want you understand my question very carefully. In the last class, students, that we all have learned one important particular point. And what was that? Be careful, students. Please recall. We did slum sale. We did slum sale. And tell me, in the case of slum sale, tell me, students, in the case of slum sale, the transaction, is it exempt or it is taxable? Only a slum sale, think of it. The transaction of slum sale, is it exempt or is it taxable? It is taxable. In slum sale, if you recall the previous example, what happened? The company has one division and that division has been transferred to another company without assigning the individual values of the assets and liabilities. That division was being transferred to another company. That is why we said that to be a slum sale. This is a case of a demerger. In demerger, what is happening? Again, one division is getting transferred to another company, which is known as a resulting company. The division is getting transferred. Slum sale was taxable. Demerger is not taxable. Slum sale was taxable. Demerger is not taxable. Demerger is covered under Section 70. Slum sale, there is no Section 70 per se on that. Why is it so? Why is it that in the case of demerger, we have the Section 70, whereas slum sale does not have Section 70 at all? Other than that question, in question there was some restructuring I told you, forget that. Only slum sale focus on that. And slum sale by itself does not have Section 70 recourse, whereas demerger has it. Why is it so, students? Why is it so?
Sir, it is clear because in the slum cell, already we are getting the
Very good.
monetizing of the asset,
Excellent. Excellent,
not in the
Radha.
case of
Very good.
demerger.
Very good. Very good. Excellent.
Thank you,
That
sir.
you have already got hold with this now. The monetization is the game. I loved, I have not assigned the value of the asset and the liabilities of the undertaking, but did I monetize? This is a real question, and you have got hold with this one. Very good. So, monetization is a game. You monetize, and then you think 70 will come and protect you. It will not happen. In fact, students, I should tell you, if you monetize and still you don't have to pay a capital gains tax, if you can answer this one, students, I will be really be happy, and your thought process has really gone at a very higher level. If you're monetizing it, means you're getting money on transfer and still you don't want to pay the capital gains tax, what you should do? Let me ask you this. I think if you can answer this,
Yes, it is under holding and subsidiary transfer that 100%
other than
wala.
that, other than that, other than that, you have got the money, but still you don't want to pay the capital gains tax, what you have to do?
We need to apply for the exemptions which is given on the capital gains.
Exactly, that 54 series exemption.
Correct.
Very good. So this is the thing now, conceptually now hold on this concept. Hold to this particular concept for this now. You are not monetizing, check entry under Section 70, whether you are covered under Section 70 or not. And the big names, now know, you already know the big names: amalgamation, demerger, succession, conversion, so on and so forth. We have seen that. And if you are monetizing, you got the money, but still you don't want to pay the capital gains tax, then you will have to see whether you can do some tax planning through that exemption route, which under the old law it was under the 54 series. Now we have got 82 and onwards. Okay, perfect, students. Very good. Let's take it further, students. Net worth of SS Private Limited immediately before demerger is 40 crores. Net book value of the asset transferred is how much, students? 10 crores. So it will be, the proportion is ready. Net book value of the asset transfer 10 crores. The net worth of that old company is 40. So one fourth is the proportion to be applied on my actual cost. Under the scheme, for each equity shares of 10 in SS Private Limited, 2 equity shares in RV Private Limited are issued. Meaning thereby, students, I would be getting 2 shares in the resulting company for a single share which I have held in the old company. This is the kind of this is the kind of, students, the equation of demerger for the shareholders. Now Mr. NK, students, Mr. NK holds 25,000 shares in SS Private Limited. 25,000 shares in SS Private Limited, acquired in 2004-2005 for rupees 6 lakhs. 25,000 shares in SS Private Limited, acquired in 2004-2005 for rupees 6 lakhs. Okay. He receives rupees. He receives 50,000 RV Private Limited shares in January 2027 and sells all of them in March 2027, students, for 8 lakhs. Answer separately, students. In this case, does the demerger attract income tax liability in the hands of SS Private Limited or RV Private Limited? Students, you have to see whether the conditions are satisfied, and the fact that the conditions are satisfied and they say it's a qualifying demerger. Didn't I told you just now? Both at the entity level as well as at the shareholder level. This demerger is not a taxable transfer, and therefore that is what you're going to say. Point number one. What about point number two? Does capital gains arise to NK on receipt of RV Private Limited shares? Does capital gains will arise? We have seen that capital gains doesn't arise on receipt of it. Again, it is not a taxable transfer. It is not a taxable transfer. Students, it may be premature, but I think I should try to, if you allow me, if you allow me, students, I'll extend it to one more head, and it is IFOs. If you allow me, I'll extend it at this stage.
Why not, sir? We are
So,
excited.
yeah, so let me in fact extend you. Here, the question, students, they are saying, does capital gains arise to NK on receipt of RV Private Limited shares? We have discussed already. It is not just like the amalgamation, same as the demerger. In fact, Kanaya has asked the same question. My question is, what about IFOS? I have received the shares. I have received the shares for free. I have not made the payment. Yes, you may say about the capital gains, but that is a different thing. But right now, what about the IFOS? In amalgamation also, if you recall, students, what happens if it is a qualifying amalgamation? Then the shareholder of the amalgamating company who receives the shares of the amalgamated company, we say that that exchange of the shares is not a taxable transfer. Is not a taxable transfer. Fine, not a taxable transfer, no capital gains. But the fact remains you receive something for free. Receive something. Did you pay any consideration for that? And the answer was no. So one may have a doubt in their mind that, sir, here the consideration was not been paid out of the pocket technically. So don't you think that something received without a consideration, remember that where I'm heading now, where I'm heading, students, might be taxable under the head IFOS as a gift tax. Gift tax, students, recall faintly in interest, you people have done it. You have received money or non-monetary assets like shares and securities is also covered, na? Even immovable properties are covered. So therefore, non-monetary assets, namely shares and securities, jewelries, or work of art, as well as immovable property. So if you have received these items, money or money worth, specified money worth, all these assets are specified, not all of them. So if you receive money or money worth without consideration or for inadequate consideration, and that difference is more than 50,000 rupees. Remember that, more than 50,000 rupees. Then the entire amount or the entire difference was not, we'll see that provision specific, but I wanted to hold your attention now. You receive some assets without paying off anything, without paying any consideration at that time. Question therefore is whether that gift tax provision will that become applicable or not. Capital gains, we have already discussed, we already now know. So if the question instead of this, does a capital gain arises, instead of saying what is the tax implication in the hands of NK on receipt of RV private limited, just I change the question. So the tax implications, students, you will not only have to say about what? Say about the capital gains part that you already will say, sir, this on receipt of shares of that resulting company or the amalgamated company, that is not a taxable transfer. Okay. That is for capital gains. So because that is not a taxable transfer, therefore no capital gain chargeability will be attracted. But then capital gain chargeability is not attracted. But what about the receipt of shares? Without consideration, whether the chargeability will go under the head IFOS. So students, this is an important part. Under the head IFOS, students, you will learn what? That such receipt on the eligible amalgamation, demerger and the restructuring, some of the cases, these cases of receipts of shares are also not considered as a gift, are also not considered for the purpose of gift tax. Not considered for gift tax. So can you see that the tax neutrality extends also to IFOS? Otherwise, what is the use? The assessee will say, okay, in capital gains you gave me the exemption, then but what is the use? In IFOS you have picked me up and you have taxed it. So in IFO, students, you have to integrate now. I'm just writing it, and if it is possible for you, just to mark it right now, because when you revise it, students, you revise it in totality. Right now, you will appreciate 30 to 40% probably, but when you do IFOs and when you revise it, don't revise in isolation, revise in entirety together. So what is the thumb rule, students? Neither a capital gains tax to the shareholder nor the IFOs. It cannot happen that in capital gains they have left you and in IFOs they have picked you. So what is the use of it? Isn't it? So it is consistent throughout. Did you all got this one, students? All of you. In fact, I will tell you some of these are the very popular questions of the interviews, huh, students? In the like big four in the restructuring departments, when you go, these becomes a very popular questions. Mergers and acquisitions, this becomes a very popular interview question, students, I must say that way. And this is the reason why, students, you just don't only think from that angle, you have to think from entire 360-degree angle. And this is one of the things that is to be considered. Anyway, students, let's proceed further. Compute the capital gains on sale of RV. So students, tell me one thing now. When the resulting company will sell when the shareholder will sell the shares of the resulting company, full value of consideration, amount that you have received. Now less cost of that shares of the resulting company, already you calculated through the proportionate formula method. You already calculated, students, through that proportionate formula method. So that will be the cost. That will be the cost. And you will get your capital gains. Now my question to all of you therefore is, last question, students, in this case. The last question is that whether the period when I as a shareholder, should I take the period only from when the resulting company came into existence, or should I also consider the period when I acquired the shares of that demerged company? Should I take the whole period, or should I split it only to the part period? Because why it is important? Again, the same question. If you take only the split period, chances are there that you may end up getting a short-term capital gains, period of holding concept. And if you combine the period, you may get the long-term capital asset because the period of holding crosses a threshold limit. Students, what is your take on that? Should I combine or should I just ignore it? Should I just take the resulting company period? Think and then answer me.
Sir, I
Sir,
think we should combine and take the holding period as portion the investment portion has been transferred. Even the investment has been made in 2004 and 5. So I think we combine whole holding period.
Exactly. Your name is Yogendra, na?
Yes, sir.
Yes, Yogendra. Very true. Perfect. Because in this case, as Yogendra has said it correctly, that exactly is the point. When I acquired Tata Sons shares, was this division a part of Tata Sons? Answer is yes. Subsequently, probably that the division got, there was a spin off and then it became a resulting company. But I held the shares of Tata Sons when this division was a part of it. So therefore, students, as Yogendra said it correctly, that the period of holding should be counted from this date till the date when I sell the shares of the resulting company. And then we decide whether it is a long term or short term capital asset, and that will decide the nature of our gain. Very good. Perfect.
sir, ultimately, what my logic is saying that it's kind of father and son relationship. Although the assets are
Yeah, yeah.
transferred from one end in the same end, but it's under the same family.
Exactly. Exactly.
So that's why
Very true.
period of holding would be from the initial aspect itself.
Perfect. That is precisely the entire point. So that is how the things are there, students. And this is the entire game at the end of the day, isn't it? So, students, perfect. Now, with that, students, we are done with this thing. I think Radha, at the end only, I think for the query that you may have for the conversion and succession, maybe towards the end of the class, you may
Yes,
just
sir,
ask
I will ask at the end. No
towards the end.
issues.
Okay. So now, students, we move to Kanaya. You have any query? And Yogendra, you any of the queries is there? Now we move to the real estate particular part.
No, sir, not yet. Sir.
Kanaya? Okay.
If you are
Thanks.
taking this topic, then we can cover it all together. If you are taking on the conversion itself, no issues. I can ask right now.
Yeah, you
Only
can
it will
ask.
take 1 minute. Only 1 minute it will take.
Okay, yeah,
So there is
definitely.
specific only one thing. The 3 years preceding, book value is being taken into consideration in one of this case. That's why I was asking that why such provisions is being taken place.
3 year ceiling. This you're talking about
Correct.
this one.
Yes.
So this I if you remember that in this case, so I think you're talking about this particular part,
Correct. Correct. Yes.
isn't it?
Yes.
So
Because
here,
company is getting converted into LLP. I got the logic that because company has to go under so many legal compliances implications, that's why it's going to LLP. But then why the specific 3 years only has been given the time?
no,
It can
3 years though. It is like a in this case, 3 years is enough for you to in this scenario. Why 3 years, students? See, 1 year I became a company. First year I became a company. Directly I became a company. Whether this, whenever somebody has to do a business, they don't start directly with a company. They start with a proprietorship concern. Then might be they will become partnership, and then they graduate to a company form. But nevertheless, I wanted to see my name as a director directly, primarily, and then and not as a sole proprietor in my business card. Directly, I made a company without realizing that my company is very small. My turnover is not more than 60 lakhs or so. And my assets are also deployed is very less. So, students, what they are trying to tell you is that, say 1 year, let's see, first year there will be a shock, isn't it? Maybe the second year in this case, second year also there may be a shock. And then third year also he should get a shock. Shock means in all the 3 years, at least, he should not exceed the threshold limit. So it means that one thing is clear in our mind, 3 years there is a consistent what? He's getting a shock. What is the shock? Neither my turnover is increasing by more than 60 lakhs, nor my assets, which you see is exceeding 5 crores. I am continuously in 3 years, I am a very small company. So with such a small company, with continuous 3 years, in either of the 3 years, he has not crossed the threshold amount. So does this small company who has ultimately 3 years at a stretch has not exceeded the threshold limit of either 60 lakhs or of 5 crores, should he be getting the benefit of? Should he be getting the benefit of the conversion? And the answer is yes, because if you say no, no, at least 2 more years, let him be small company for 2 more years, he will collapse, liquidation. So therefore, this is but say any one of the year he goes beyond the threshold limit, it means this company has a promise. That is the reason why they have given this 3 years period. So 3 years
Yes.
is a test. So in any of the 3 years period, he should not cross the limit. Limit is 60 lakhs for turnover and 5 crores is for the asset. Got
Even
it?
if he's going for within 2 years, then this condition need not to be checked, right, sir?
That is a query. Just a second. This 3 years is the minimum period, Radha. Because see, 1 year only, first year you do a conversion, that it should not be an issue. No? 3 years is the minimum threshold period. So you need to be 3 years old at least in that context. Because this test has to be seen. See, first year, everyone is a small company. Nobody would know the promise. But by 3 years continuously, only then we'll come to know that yes, this person for the 3 years at least, his turnover is not going beyond 60 lakhs. Or for that matter, this particular thing. So 3 year stretch is a continuous stretch. So you cannot say that first year only I was a company and second year I'm doing the conversion. Let me give the benefit. You need to be this many year old. Otherwise, this is only for the small companies. And how do we define small company? Only 1 year or 2 year criteria? No, at least 3 years continuously. You need to be small company.
Yeah, like even 3 years criteria is required for getting listing also, as per the SEBI
Listing also.
regulation.
Yeah, yeah, very true.
So
That is
that
all.
means 3 years specifically, it's a lock-in period which needs to be satisfied under this section.
True, very true.
If it is less, then you cannot convert it. You
You
need
need
to
to
wait.
wait for 1 more year to just see whether you are crossing the threshold or you are still under the threshold. If it is still under the threshold, then do the conversion in the next year after that.
Okay, sir, got it. Thank you.
Okay. Okay. Now, students, let's come to the real estate particular part. And there are provision, students, that you learn. And see, one way or the other, real estate transaction, either professionally or personally, students, you will end up primarily having some sort of interplay or for examination for sure. So one of the other or the other students, you will have certain things. So students, this particular, uh, okay, students, tell me one thing, notes and all. I think all of you have got the notes in the portal. Yogendra, you have got the notes through portals. All the notes are there, students. In our
Yes, sir.
portal, if you log in through the portal, you'll find all these notes. Huh?
Yes, sir.
Uh, so this note is there, real estate today.
Sir, today's notes was not updated.
Okay.
Sir,
So,
and before continuing to with real estate, actually when we are compare with the Companies Act or LLP Act, first if we have go through Companies Act, if we have 1 year's one set of like one financial year set of financials, then we can convert into LLP, right, sir? As per Companies Act, there is no requirement of
that,
minimum
that
three
you
years.
can do that, but you will not get a tax benefit. But to
Okay.
get a tax benefit, that 3 years threshold criteria needs to be met. So I'm
Okay.
not saying that you can't do it in this context. You can definitely do that in this regard. But in doing so, will you be getting a tax benefit? And the answer is no.
Yeah. Okay,
That is
sir.
what it is. You can
Okay.
definitely do that. So I'm not saying that tax is only for it. If you want to take a tax benefit, these conditions needs to be satisfied. That is what they say. It's not that you can't do it at all. They don't say that. You can do it, but to get tax benefit, you need to cross this threshold, or this is the criteria that needs to be fulfilled. Okay,
Okay, sir. Thank you.
perfect. Okay, the truth. Now, if I just, students, anyway, again, just to keep the things comprehensive, because then you may revise it separately, real estate transaction. And this real estate transaction, students, you'll get everything, even the TDS, students, the interlinking in your CFR examination, students. We have seen that even they interlink the TDS provision. Inter CA, students, you have done this. Remember the buyer 50 lakhs threshold was there. TDS provision you would have done in your inter CA, when the buyer has to make the payment for the consideration which was 50 lakhs above property, then the buyer is under the obligation to deduct TDS. So therefore, students, this particular real estate transaction should be seen from both the sides. Right now we are doing from the transfer's point of view, but don't take your eyes off from the buyer point of view also. Buyer, students, will have an implication for the TDS, because he will have the obligation to deduct TDS if the threshold increases. Buyer also will have something to see under the head IFOS. Do you all agree? Just now I told you, in IFOS, what I told you about IFOS? I told you about the IFOS that, students, that if you get a asset which is either a movable property, specified movable property, or immovable property, either without consideration or at a concessional rate, and it crosses the threshold of 50,000, then what happens, students? Then what happens? Then the recipient, that is a buyer, in my example, the buyer will end up having what? End up having the IFOS implication. The amount, the difference will be taxable under the head IFOS. So therefore, the buyer has its own set of obligations, and it will have some sort of a consequence. Obligation of TDS, consequence under IFOS. The transferor who is transferring the asset, for him there are some specific set of provision that he have to deal with it. Not only that, the transfer, students, for him then there is a tax rate, special tax rate. And the transfer, students, would also have the opportunity to do what? He will have the opportunity to go for that 54 exemption that you people knew about it, which now is under 80, section 82 series and onwards. So therefore, when you think about the real estate transaction, the way the law has been made, students, at this particular point of time, it is not only a transfer specific, it is also now a transferee specific. And questions you will see in your CA final, it will have both the particular issue involved. And that is the reason why, students, you deal with this in this particular way, you will done with your entire CG part. And not only CG, the important aspect of IFOs also, which I have told you about the immovable property. Let's then begin. So, students, what I have done is that just to get started, you will find that the same definition like capital asset. So, this is a checklist, students. Checklist, eventually you will come to know that, sir, we have already covered till examination this. Yes, students. The checklists are given. If you see over here, students. Students, first, capital asset definition we have done. Remember, first class, capital asset definition. Property of any kind. Any particular asset in the case of real estate, tell me, students, any real estate which was excluded from the definition of capital asset? Any real estate which was excluded from the definition of capital asset? Recall, students, all of you. Any capital asset, any real estate, if it was excluded from the definition of capital asset. Quickly, recall.
Sir, it's agriculture land.
Rural agricultural land. Always say rural agricultural land.
Rural, yes, rural agricultural
So
land.
rural agricultural land was specifically excluded from the definition of capital asset, students. So that's a specific exclusion, apart from
Sir,
what we
stock,
discussed.
sir, stock in trade, sir.
Stock and trade, yes, you can say. If
Sir, sovereign,
supposedly real estate can be a stock and trade to a particular the builders and all,
sir,
isn't it?
sovereign gold bond.
It will be still a security, I will say that way. So the question is majorly focused on what, Kanaya? That any real estate exclusion, any real estate exclusion in the definition of capital asset. So a direct exclusion is a rural agricultural land. Stock in trade, you can say yes, it can be excluded if I am a like a dealer. I'm a dealer. In that case, for me, the land is what stock and trade. I sell and purchase land. So therefore, in that situation, for me, it becomes what a stock and trade. So that is a sectoral specific, not for everyone. That the real estate would be a stock and trade, but for those who for whom the real estate is a stock and trade, for them it will also be excluded. True. Okay. So therefore, yes, perfectly. In the definition of transfer, students, now just be careful, students, in transfer definition. Now, students, I we are not. You can just do it, students. In the rural agriculture land, students, remember, you please read this one as a homework, students, if it is possible. What do you mean by rural? So that municipality, aerial measurement, all that thing. I think that please you just refer this particular part. So that is what will suggest you that this is a rural agricultural land. This is what will suggest you that it is a rural agricultural land. Okay.
Sir, I have read it, but can you tell me under which current section this is being covered? Like earlier it was under 2 subsection 14. Right now, in which section it is being covered?
Two clause
Two, 222, sir.
220.
220?
22.
220? Okay.
Yeah,
Just
Thank you,
wait.
Kanaya. Yeah.
Yeah,
yeah.
222.
Well,
Perfect. Very good. Very good. Excellent. 222. So I'll have to, I still confirm, I just can't extempore. It is now difficult with the new particular law. Family, to tell the numbers and all, extempore is very dangerous. But yes, it's so nice to know that you people are remembering and putting that effort. Good show. Keep going. So now, students, okay. Then, students, what is the next definition that we have seen? After this, capital asset, after this, which definition that we have seen? The definition of transfer, isn't it? Now, students, just have a look to the definition of transfer. I have told you, you may have forgotten by now. And by the way, Yogendra, you will find the notes and all the students in online. In the notes, this is a feature that you will find. I have already marked from your module. This is the page number of your module that you will find. Okay. So therefore, this is the section number. This is our notes. If somebody would want to do some more detailed particular reading, they can refer the module page number 4.4 like that. You're going to find. So this is the way the entire notes are being arranged. Now, students, if you see over here, the definition of transfer, I told you that there are a couple of cases. There are a couple of cases which I'll take this out right now and we'll discuss it in real estate specifically. Those couple of cases now we are going to address. Please have a look. So this we already did. Sale, exchange, relinquishment. We also did extinguishment of right, compulsory acquisition. By the way, students, in compulsory acquisition, generally the compulsory acquisition by law, and generally you will find in many cases the compulsory acquisition is in respect of a real estate, like a building or a land. That is what is compulsorily acquired, isn't it? So that is generally what is the case. Although they have not been very specific, they have kept the door open. Compulsory acquisition of anything by law could be considered as a transfer. But practically, we know the government does compulsory acquisition, say for on a real estate particular project, say be it a land, be it a building, so on and so forth. We discussed also the conversion into a stock in trade, students. The conversion into a stock in trade also was being discussed, isn't it? That is also was being discussed. Now the last two particular points, students, that you can see. Be careful. Part performance and enabling enjoyment. Just read this particular two part. Students, just a second. Just read it, students. I'll just come. True with this, students? All of you. So, students, if you see over here, sale, exchange, and relinquishment. We have done this part performance and the enabling enjoyment. Part performance. What exactly it is? Possession of immovable property, allowing to be taken or retained in part performance of a contract, referred to in section 53A of the Transfer of Property Act 1882 is included. So students, tell me one thing. Part performance would be considered as transfer. So supposingly students, do you know what exactly this happens in 53A in that situation? By giving a possession. So supposingly I am a seller and we have made an agreement. The agreement says that you give me say 80% of the consideration amount, and just an example, and I'll give you the possession. Okay, maybe we will do registration later on, but I'll give you the possession. The mere possession now. So possession has happened so if I just give a particular case study, students, this is an important one. You just need to know in this context, all of you. So, students, just for you, if it is possible, this is because it's an important particular criteria for real estate. Students, just have a look. So here it is a case of here it is a case of students. I have purchased the asset, students. I have purchased the asset in year number 1. Immobile property, this asset, students, I may say asset, but it will now be considered as an immobile property. So this was year 0 again. Purchase. Please comment on this for students. Then in year 2, students, what have we did? Agreement was entered. Agreement was entered, students. Now, when the agreement was entered, students, over here, as per the agreement, primarily, so we entered into the agreement. Okay, now this particular part, students, we entered into the agreement, then the consideration, 80% consideration was given, 80% consideration was being paid. Now, 80% consideration was being paid, and in this point of time, possession was given. Possession was given. So this was my next milestone. Huh? Possession was given on 80% of the consideration paid. After that, students, balance 20% was paid. Balance 20% paid. And after that, finally, students, the registration happened. Balance 20% paid, and after that, students, the registration happened. Okay. And maybe say you can say this year 3, this is year 4, and this is also year 4. Agreement in year 2. Year 3, 80% consideration was paid, and in consequence of that consideration, the possession was being given. And therefore, thereafter, year number 4, balance 20% was being paid. And then thereafter, immediately registration happened. So when the transfer has taken place, students, when the transfer has taken place in this case,
Sir, I think in year 3, when the possession was taken by the buyer, the transfer has taken place.
Very good, Yogendra. So therefore, it is year number three. That possession is what is now sufficient. In a part performance, still 20% is left. Still registration is yet to be done. But this is considered as a transfer if you give the possession, which means you are giving the control. And by virtue of the control, they have said under the Transfer of Property Act that the fact that the possession now has been given to the buyer, the control now is of that particular buyer so far as the property is concerned. Therefore, that by itself will be considered as a transfer. In a layman, what should substance over the form? Registration is yet to take place, but the buyer now has become a beneficial owner. The buyer now has become a beneficial owner, and therefore, this is what it is. Students, let me ask you this question. I think, let me see whether you recall that or not. There was one particular place also where, by virtue of the possession, that there was some entitlement given to the SSE. By virtue of the possession, that the SSE was entitled to something. What was that? By virtue of the possession, the SSE was entitled for something. What was that?
Sir, is it leasing entitlement?
Lease? Kanaya, you are quite near, may I say that? Think over it one more time. Just because of possession, there was some entitlement that you have learned. I'm not using a one more very perfect word, because if I use that very perfect word, you will immediately give me the answer.
Got it. Deemed owner.
And in which context you have learned?
Uh, Sir, it was like you had given the example that a land which is being on lease of 99 years lease period, and then the particular or lessee is
Yeah.
constructing the building. Then it's like that. Yeah.
Yeah.
So he's getting the deemed ownership to claim the tax
Which
with
means
regards
that
to.
you have learned these things in the form of a depreciation.
Yes, yes, yes.
That was this discussion students that were held in the context of the depreciation students. Karaya, isn't it? That's the reason why I never wanted to be very specific
Yes.
out of it. If I would have been very
Yeah.
specific, immediately would have answered that thing. So
Right.
I was just trying to be as near as possible. So yes. So tell me, even in depreciation, remember that Mysore Minerals case, that transfer of the buses and all, state
Yes, yes.
government
Second
has
hand one.
transferred second-hand buses.
Yes.
Yes, second-hand
Correct,
buses.
correct.
Correct. There you tell me whether what happened in that also. I was under the possession. Registration didn't took place. Okay, but I was possessing those buses to the
Yes.
exclusion of the other person, and I was using it for my business and profession.
Right.
Isn't it?
Yes.
So
As a
possess
beneficial owner.
that is
Correct.
again the beneficial ownership. So therefore, the lease, all that thing, if you learn the income tax law, therefore now can we conclude the way we have concluded for capital gains? Sorry, the way we have concluded for amalgamation. What I told you, income tax law recognizes amalgamation in the nature of merger or purchase. Amalgamation in the nature of merger
Merger.
only has been recognized. So now can we conclude it is the beneficial ownership or beneficial transfer is what is recognized under the income tax law? Isn't it? That exactly what is the recognition given over here. So actual registration, full payment, all that becomes a secondary criteria. The main criteria, therefore, if you see, in fact, now students, if you learn this, na, house property, if you see your inter-CA module also, in house property, there is a deemed ownership concept. I am
Yes, sir.
selling. You know what will happen now? So tell me, in year number three, what is going to happen? I am a transferor. I am Mr. A. I am Mr. A. I have transferred it. So what will happen? You say that, sir, part possession has been given by you. So you have to pay capital gains in year three. Why? Because as per the definition of transfer, giving away the possession on a part performance of contract is equal to transfer. So you have given, sir, to your buyer the possession of the asset So in year number 3, you will be liable for capital gains. Do you know what will happen to the buyer now? Buyer registration has not yet taken place. But the buyer, for him, whether the deemed ownership of the house property will that come into play? And on that basis, whether the annual value of the house property will that be accessible in the hands of the buyer? Answer is yes. So I make an exit by having a chargeability of capital gains in year number 3. I'm making an exit. I pay the capital gains tax. I make the exit. In which year? Year number 3. The buyer makes an entry. The buyer makes an entry. How the buyer makes an entry? How the buyer makes an entry, students? Under the concept of deemed ownership under the house property, the buyer will make an entry. So, students, you should not think. Now, are you now enjoying this income tax, the entire thing, the entire heads of income? See how they are now getting into it. In which side you are, you will discuss that heads of income. If I am from the side of the transfer, I am talking about the capital gains part. If I am from the buyer point of view, for the buyer, I will have to think of TDS. For the buyer, I'll have to think of IFOS. I told you about IFOS. For the buyer, I'll have to now start thinking about house property. This is the beauty of taxation law.
So, sir, deemed ownership will be taking place from the year 3 till year 4, till the actual title you get, right?
No, yeah, deemed ownership, and then in any case, he is the owner. Deemed ownership for limited purpose.
That for the 1 year itself.
Yeah, for only for assessment purpose, so that at least he is assessed under their house property. After that, in any case, he is the owner, so nobody bothered on that. So deeming fiction, rather what you are saying, deeming fiction is for that 1 year period. 3 years to 4 years. Okay? Are you okay with this interplay between seller or buyer, or I will only be sticking to this? You tell me, students, what exactly would be your ability to consume. I can take you through to the seller, I can take you to the buyer and the 360-degree level. So at least we are not discussing IFOs. I'm touching upon that this is how you should think. We are not discussing IFOs. I'm not telling you the provision inside. But this is always you should remember it. So you should not read it in isolation. You should integrate. But definitely I'll do the further integration if you say so. And sir, yes, we are okay with integration, or we love
Yes.
integration, or else I'll
Yes,
just
we are
have the
okay.
Sure for
isolated.
integration.
Integration is fine, students.
Yes, sir.
Yes. Sir, in the capital gains, I think you link the deed owner with that of PGBP, I guess, as far as I remember.
Which deemed owner?
PGBP, the deemed owner concept was being taught by you in PGBP, right? Not in capital gains, as far as I am remembering.
Deemed owner here we don't require in capital gains, because capital gains
Yes.
is the exit side, na? Where you are exiting. Capital gains, what you are doing? You are exiting. So you are making an exit. So when you are making an exit means, in that case, you are only on the, you are having your capital asset. Yes, you are having it, and you are transferring it. So capital gain is not for the deemed owner. Deemed owner are meant for those two heads where you are holding the asset, and because you are holding the asset, you are liable for assessment. And that head, which is that head? Because of holding the asset, you are liable for assessment, house property. And because of holding the asset, you are eligible for depreciation. So the deemed ownership concept, if at all it has to be discussed for holding the asset, it has to be under the head house property and PGBP.
Either of them, either house property or PGBP.
Yeah,
Any.
because PGBP
Yes.
you will have, he has to do
Correct.
business, na? He has to do
Correct,
business.
correct. Got it, sir.
He is using the asset for the purpose of business and profession. Isn't it? This head, CG, is about transfer. But transfer of what? Stock in trade or capital asset? Capital asset. So first it has to be a capital asset, and thereafter it has to be a transfer. And then we'll decide which is the year of chargeability. That is the third part. But at least there needs to be an existence of capital asset, and that capital asset needs to be transferred. Then we will decide which will be the year in which the transfer will be chargeable. Okay?
Yes, sir. Fantastic.
Okay,
Understood.
if you allow me, I'm just out of curiosity, last particular point, students, only last point. Otherwise, you will not even think of it. This two-way theory which I'm discussing right now, see how we are thinking about it. We are thinking not only from the one side, we are also thinking from the other side. Now, just remember, students, I am receiving an amount for non-compete agreement. I am receiving the amount on account of non-compete agreement. Okay, for business, obviously, I was being told that you are not supposed to do this business. And for that, I'm receiving a particular amount from other company. So the amount that I have received on account of this non-compete agreement, you know that it is chargeable under the head PGBP. We have seen the specific charge under the head PGBP. There was a chargeability, isn't it? One of the item was any amount which is paid and any amount which is received would be any amount which is received would be charged under the head PGBP. Received towards what? Received towards the non-compete agreement. Okay. What about the payer of the amount? The one who is making the payment. Payment towards non-compete agreement. Now he is paying because of his business. He does not want me to compete in business. So he is paying me for his business. So it is for the purpose of business. But is it a capital expenditure for him? Is the payment for that non-compete agreement, is it a capital expenditure for him? Think and tell me. I have taught you the principle of capital expenditure as well. Right from that Empire Jute Company Limited. Remember Nani Palki wala judgment?
Sir, is it deferred capital expenditure?
No, there is no concept of Kanhaiya, no
Uh,
concept of deferred capital expenditure. It's only whether it is capital or not is what is the only test.
sir.
In fact, I
Yeah.
must tell you, just a second, Radha. In fact, I must tell you, income tax law even does not tell you that it should be a revenue expenditure. In the general deduction, very loosely we say, in the general deduction section 34, which is general deduction, isn't it? We say very loosely, earlier it was 37. Yogendra, earlier it was 37, now it is 34, general deduction. In that general deduction, Kanaya, they are not saying that the expenditure should be a revenue expenditure. What they are saying, it should not be a capital expenditure. That is it. You have to only prove that it is not a capital expenditure. You will say, sir, if you say that it should not be a capital expenditure, it means it's a revenue expenditure. I don't know. I can't say. If an expenditure is not a capital in nature, I can't say it is a revenue expenditure. I can't say. In accounting, you may say that. Maybe they will say that way. A private company, if it is not a private company, it's a public company, like that kind of a definition may exist. In income tax law, the law says it should not be a capital in nature. I just need to satisfy and just need to prove to claim a deduction under 34 that it should not be capital in nature. Once I have proved this, that it's not a capital in nature, I'm not supposed to try to further ascertain then whether it is a revenue expenditure. I don't know. Same way, Kanaya, this deferred revenue expenditure, this term doesn't exist so far as the capital, so far as the income tax law is concerned. So therefore, just only a simple particular, just focus on this. He has made the payment. That payment was for business, and the payment was towards non-compete agreement. So the payer, for him, it is an expenditure. And he's asking you that should I claim this as a deduction under section 34? He's asking you that whether this expenditure will it be considered as capital in nature and therefore it will be disallowed under the general deduction of section 34. What is the answer, students?
Sir,
Sir,
it is not
because
allowed, sir.
yeah, Kanaya, you continue.
This
I
is
think, sir, it is not allowed, sir.
okay. And the reason, Radha, can you give the reason?
Yes, sir. Reason was in Empire case, Palkiwala, like he had fought na, so it was like capital field. Is it impacting the capital field? Is it impacting the balance sheet? The answer is no, I guess, because it is not a prima facie affecting the majority of the share capital in this case.
Share capital or fixed asset? It
Fixed
neither,
assets,
in
yes.
fact, it doesn't enter into the capital field of business. Now, by paying your the non-compete, Kanaya, by paying the non-compete X amount, it neither enters your fixed asset side nor it enters your share capital side.
Right.
Isn't it? And therefore, it doesn't enter into your capital field, and hence the expenditure is not capital in nature, and accordingly, it will be disallowed. So, see the interplay primarily that non compete agreement for the receiver, it is chargeable under the PGBP. For the payer, it is allowed as deduction. It's a zero sum game. This is known as zero sum game, but not every particular case you are going to find that, sir, for him it is an income, so for him it is allowed as deduction. Not in every case. Say for example, TDS default. If you would have done a TDS default, then if you would have done the other sort of a defaults, cash expenditure disallowed, isn't it? So therefore, there could be the case where the payer, for him, the deduction may not be available for some other reasons. For some other reason, students. Is that clear to all of you, students?
Sir, but what kind
Yes.
of expenditure we will classify it? That's what I'm thinking.
No, no,
If
don't,
we,
don't have to worry. As far the income tax law is concerned, you don't have to worry. Income tax law
okay,
only talks about it should not be capital. Okay,
okay,
and when you write also the answer, although I must say that even in some of the judgments also, they have got very loosely they used to write revenue expenditure, but revenue expenditure are used in a very limited place like scientific research. There you have revenue and capital. That is what it is. In 34, I'm talking about it, which is a general deduction. They don't say, they only require that the expenditure should not be capital. That's it. But if it is not capital, therefore it is revenue, that is something you should not cross the boundary. Your answer should be debt specific. It should not be capital in nature. Students, in your examination, one adjustment will come in section 34. And when you write for section 34, general deduction, you will write it should not be capital in nature.
so ultimately we are not concerned with whether it's revenue or not, but it
Yeah,
should not be a capex.
capital.
That's it.
That is true. Perfect.
Okay, sir. Got it.
Okay, and this is why I'm given this example one more time, non-compete, because there is a sharp case law, sharp system, Supreme Court. It is covered in their ICAI module. Very important to 2025 Supreme Court judgment, same judgment. So that's the reason why I thought just to quickly revise that particular point as well with all of you. Now, students, now just have a look, students. Apart from that, please come to the specific capital gains provision. Now, students, here, just a second, students. You want to take a break, students?
Sure, sir. We can.
Kariye.
10 minutes
Yuvendra?
break. Okay.
Okay, students, take a 10 minutes break and then I'll just see where that JDA is gone. Otherwise, unnecessarily I'll keep searching that. So, students, 10 minutes break. Sanket ji, 10 minute ka break. संकेत जी स्टार्ट करते हैं. Radha, Kariya, can you hear me?
Yes, sir, I can hear you. I guess Sanket sir is not available. Okay.
संकेत जी start. Uh, so welcome back, students. So students, now, so if you see over here, students, very carefully, we'll do one by one everything. Now, students, so students, just a very quick recap. Why students we are giving this? Because sometimes what happens is that the question comes from a real estate point of view, and the same concept that we have learned, like year, what is a year of charge, what is a transfer, same thing they target from the real estate point of view. So therefore, I have kept the same particular provision over here again, but we will revise now from the real estate perspective. Students, as we know, the general charging section, which I have told you, including the page number of the module, the general charging section, students, is section 67.1. And we know that the year of chargeability is the year in which the transfer has taken place. However, in the case of conversion of capital asset into stock in trade, just like for example, I have a big land which I have inherited from my father. So it was held as an investment. Investment means as a capital asset. But now tomorrow, I think that I should enter into the business of plotting the land and then selling it off. Plotting the land and then selling it off. So that capital asset is now getting converted into a stock in trade. So if the capital asset is converted into a stock in trade, we know that it is a transfer. It is a transfer, but the chargeability is postponed in the year in which the stock in trade is actually sold. So therefore, that is what we are aware. So that is about this section 67.6. We have already discussed this. I'm just revising this from the point of view of the real estate transaction. Compulsory acquisition, students. I just today itself we discussed that compulsorily the government may acquire. Now I told you, students, it is the first year itself in which you have received the compensation amount, not in the year of compulsory acquisition, but in the first year in which you receive the compensation amount, even if the compensation is received in part, doesn't matter. And we all know that the entire computation has to be done in that very year itself. Entire computation has to be done in that year itself. So original compensation, year in which compensation or part of it is received. Okay, in even if it is received in part, I told you, students, even if the compensation may have been received in part, you have to do the full computation of capital gains. Then, students, there is an enhanced compensation that I already told you, enhanced compensation. Supposingly, you are not satisfied with the compensation that you have received, you may have approached the court. Court awards you an enhanced compensation. So obviously, students, that court award may have been declared very later, say many years later, and I have computed the capital gains originally in the year in which I received the compensation, and subsequently I'm receiving the enhanced compensation. I told you at that time also, repeating it again. Whenever I receive the enhanced compensation, that will be the year in which I will be charged for enhanced compensation. So which year the enhanced compensation will be charged? The year in which I receive the enhanced compensation amount. And students, what about the cost of acquisition? What would be the cost of acquisition that will be reduced? I also told you the same.
It's zero.
Zero.
Nil.
Perfect. Very good. Nil. And the entire enhanced compensation will become the capital gains. Okay. So this is what it is, students, over here. Now, students, Now, students, specific development agreement. This is a joint development agreement. This, students, I'll discuss with you. There is a problem. This same thing is given again in detail. I'm not any case doing the same thing in detail. We've already did it, but specific development agreement. This there is a problem on that. So we will do it probably on the problem side rather than right now revising it on a summary side. We'll discuss this particular part. Now, interest on compensation. This is the IFOS entry, students. I think you may have, although this would have come in IFOS, but still, good that we will revise it over here only. These are sections of IFOS, students, by the way. Section 92 is the charging section of IFOS under the new law. So, obviously, if the compensation has been received to you, delay. Students, if the compensation that is there has been received by you but late, there is a delay in receiving the compensation. So whether you will receive the interest also on such delay? And the answer is yes. And if there is an interest, students, in that case, that compensation interest will be charged in which year? Not as per the method of accounting, but in the year of receipt. Shall I ask you, students, and shall I trouble you again? If you want to get trouble further, or else let's continue. Towards the end, students, I'll ask you. So that let's probably not right now. I'll trouble you towards the end, if you allow. In this case, but just remember this: interest on enhanced compensation is taxable in the year of receipt. In the year of receipt, do we have any deduction for that interest amount? Yes, there is a flat 50% deduction, students, that has been allowed in this case. That is it. So it's more like a standard deduction, students. So IFOS, congratulations, students. IFOS also has a standard deduction. In fact, there are 2 or 3 standard deductions which are there under the IFOS. One for family pension. If you can recall interest here, you people would have done it.
Yes, sir. 1/3 or 1/5.
Exactly, 1/3. So that is what. So there are some few standard deductions which are there, which are very specific. It is not a general standard deduction. So please understand. Now this is how you should recall and see. This is how you get a control over the heads of income. Salary, there is a standard deduction: 50,000, 75,000. Is it a universal standard deduction? Yes. Anyone who earns the salary amount, irrespective of his salary, this is a flat deduction. So it is for the entire head. What about house property? Standard deduction, universal, entire head? Yes. PGBP? No. There is no standard deduction at all in this context. And coming to what? Coming to the head IFOS, there are some standard deductions which are there, but they are not a universal standard deduction for the entire income of IFOS. Only for few items we have a standard deduction. One we are doing it right now, which is interest on enhanced compensation amount. That is tax in which year? Year of receipt. Is there any deduction? Flat 50%. Do you all remember this particular thing, students? This is how you should remember, students. That's how you should get a grip now. It's time that now we should do a problem of this thing is that when the students only be in a very micro space. No, you now need to, when you learn in the micro space, you should know what you learned earlier. And you should now be in a position to have an opinion formed, or you should be in a position to generalize. Exactly, this is the head has got this head has got this head has got this. That is how you will have to proceed. That's how you get a control. And once you get a control, you get a confidence. Let's proceed. So a deduction equal to 50% of deduction is allowed and no other deduction is allowed. I know that. Okay. Let's proceed for the students. Now comes to the computation part. Students, you remember technically there are 4 computation, but 3 computation is very popular. One is a slum sale. Computation of slum sale, students, we have done. Already that has been done. Slum sale. Another is the computation in respect of a non-depreciable asset. And the other one is the computation of a depreciable asset. So it is a slum sale, depreciable asset, non-depreciable asset. This is a computational provision. So mainly, students, if you know in the depreciable asset also, you know the block format. And students, if you know the block format, let me in fact take you to that block format. Recall the block format of PGBP. Opening WDV, add additions, and that additions is in the actual cost, and then less money which is payable. Money which is payable, students. That is how you reduce it. And when you reduce the money payable, which is nothing but money that you receive on account of sale, destruction, or from insurance compensation, whatever it be, the money is received. Now, true, tell me one thing. If the money payable to money received by you is more than the WD open WDV and the actual cost, then what will happen in that case?
Sir, capital gain will arise.
Capital gains will arise. Or may I also ask you another way? Say for example, the in this case, so capital gain will arise. Though the block still exists, some of the assets in the block are sold at a price which is so high. Some of the assets in the block are sold which is so high that the opening WDV and the actual cost probably has already been absorbed in that selling price, and excess selling price has resulted into capital gains. Excess selling price has resulted into capital gains. Isn't it? That is what is the capital gains implication when it comes to the depreciable asset. What about the non-depreciable asset, students? Just pay attention now. Be careful. All of you students. For non-depreciable asset, this is what it is. Students, section 72, all the module page number, students, has been given to you. So therefore, I'm just giving module paragraphs are these things. The format, students, is the same. Nothing new. Just section is new. Earlier it was 48, now it is 70:1. That does not mean that the format is also now new. Same format. What is the format? Full value of consideration, less expenditure incurred wholly and exclusively in connection of transfer, net consideration, less cost of acquisition, cost of improvement, and capital gains. I told you earlier, and last time I'm telling you again. This is the format you get right from the first value till the end value. For the head capital gains. Even for house property, do we have the format? Yes, GAV, municipal tax paid, NAV, standard deduction interest. Right from the first value, that is a gross annual value, we get each and every element determined or ascertained in that house, in the head house property. House property and capital gains, they have got the format. What about the head PGBP and for the head IFOS? Do we have a format like this? Do we have a format like this? To that the answer is no. There in the head PGBP, I told you, if you remember and if you can recall, there the mandate is to start with the accounting income, income as per the commercial accounting principle, and that mandate is given under section 276, if I'm not wrong, of the Income Tax Act 2025, which says that in computing the income under the head PGBP or under the head IFOS, you will start at a threshold level, and the threshold level is net profit or the income as per the books of accounts or as per the commercial accounting principle. So you start with the accounting income, and from the accounting income, which is your starting point, which is your base value, on that base value, what you do the adjustment of all the heads, which are all the items which are there in the heads of income, which is PGBP. So PGBP, what you have only learnt is only add less, add less, add less on a particular value, and that is a base value. And what is the base value? Accounting income. And not only that, you do the adjustment under the head PGBP sections, but also you do adjustment of ICDS 1 to ICDS 10, students. So accounting income is made as per the accounting principle, accounting standard. And if accounting standard, because of that, there is a prudence, there is a revenue recognition as per the prudence, as per the conservatism. What happens then? In that case, then you come to what? Come to the real particular thing. And what is the real particular thing? Indeed, students. So that particular accounting income, students, as we can say, is further adjusted with the ICDS standard also. If the ICDS standard has a divergent treatment as compared to the accounting standards. And finally, that will give you the PGBP. So is also the case with IFOS. So these two heads of income require a base value. On the base value, you do the adjustment, and that is it, nothing else. Is that clear to all of you students? So this gave me the last time students to again recap this particular computation. Formatted computation for two heads, house property, capital gains, and other two heads, we don't have a format. We have a only adjustment on a base value. Base value is accounting income, section 276. Fine students? Perfect. Now cost of acquisition students, if you see over here, probably just important particular part, this particular thing you should know. Real estate, especially when it comes to real estate transaction, asset acquired before 1st April 2001 students. Asset which is acquired before 1st April 21 for 2001. What do you will say of this? The SSC may the SSC may use what? The prescribed substituted cost based on FMB as on 1st April 2001, where statutory option applies. Where what? This statutory option applies. So SSC may use the prescribed substituted cost based on the FMB. Whatever is the FMB, students, as on 1st April. So if I have purchased a house property, our father have purchased a house property in say 1970, I have inherited that house property. So what will be the cost to me? Cost will be the cost to the father. That cost will be compared with students with the FMB as on 1st April 2001. And whatever is higher, that higher amount students would become the actual cost for me. Land building ceiling students, in this case. For land or building, FMB adopted as on 1st April 2001 cannot exceed the stamp duty value wherever available. Okay, so if the stamp duty value is available, then that FMB value will have a upper limit. What is the upper limit? Stamp duty value, if stamp duty value is available. If stamp duty value is not available, then definitely it is only the fair market value. As simple as that. They will not target you in this way, but you should know the provision. Gift, will, inheritance, partition, students, you know that in this context. Cost will be the cost to the previous owner. In this case, students, cost to the previous owner. Students, now tell me one thing. You have to be careful on this one. Sometimes they do ask these kind of a question. So you just be careful. Supposingly, students, here, father has acquired at rupees 100. Okay? Then father has done improvement of say rupees 10 in that context. Thereafter, son got asset on inheritance. Inheritance. So because of inheritance, section 70 will apply, not a taxable transfer. Because of inheritance, section 70 will apply, not a taxable transfer. Then son has also done the improvement in this case. Son has also done the improvement, students. And that improvement, students, in this context, say it is 20. And then finally, son is transferring. Transfer of capital asset by son. So students, tell me one thing. Obviously, you know that, sir, this section 70, because of this section 70, cost will be the cost to the previous owner. Because this inheritance is not a taxable transfer under section 70. So therefore, when the son will sell the asset, at that point of time, the capital gains will be computed. At that point of time, the capital gains will be computed. What is the cost in the hands of the father? The cost in the hands of the father would be, sorry, what will be the cost in the hands of the son? The cost in the hands of the son will be the cost to the previous owner, students. The cost to the previous owner. So therefore, now students, in this context, if it is a cost to the previous owner, it will go to the father now. It will reach to the father level. And once it reaches to the father level, students, now the question to all of you is, whether the improvement incurred by the father, will it be considered or not? In deciding that improvement which has been incurred by the father will have to be considered or not? And the answer is yes. So therefore, in that case, where you have reached, you just decide that first. You have reached at this point. From this point till the time of transfer, whatever is the enhancement or the improvement that may have taken place either by the father or by the son has got no relevance. It will be considered in the computation. Because your starting point, students, what is the principle? What is your starting point? Your starting point is at what point when the father has acquired at rupees 100, and from there onwards, primary students, the further improvement has to be seen. That improvement may have been done by the father or it may have been done by the son. It doesn't matter. Is it clear to all of you students? All of you. Now, students, this is an important particular part. So over here, students, please have a look. There are some important judgments, students, very old judgment, but of Supreme Court. You may copy down this case study. VSMR Jagdish Chandran. VSMR Jagdish Chandran. So, students, here, facts of the case. So, Mr. A takes a loan. Mr. A acquires the asset for rupees 100. Okay. He takes the loan. He takes the loan by mortgaging the capital asset. Let's say the capital asset is a house property and he has taken the loan of 30 or maybe say 50. Okay. Then, students, he repays the loan. 50. And after that, he transfers the capital asset, say for 300. He is transferring the capital asset for 300. Okay. Is transferring just a second. So if you've copied down this one, students, my question all of you would have realized. Question, students, to all of you is this. Whether now he's calculating the capital gains, students. The son is now calculating the capital gains. What is happening? Now, students, how is calculating the capital gains? I'll show you. So the calculation of capital gains by the son goes like this. So at this point of time, full value of consideration 300. Less cost of acquisition 100. Okay. Now he's also reducing cost of improvement, students. And you know what he is reducing? What is he reducing, students? Mr. A? he is reducing rupees 50 in respect of the loan that he has repaid. He is reducing rupees 50 in respect of what? In respect of the loan that he has repaid, students. Can you see that? He is reducing it from 50 in respect of the loan that he has paid, repaid. So he said that I am improving to my title because by because the loan has created what, students? Has diluted my title, has diluted the title. Because I have only one, because it is mortgage. So I have got a limited right now. After taking the loan, I have now a limited right over the asset. But by repaying the loan, I have improved upon my title over the asset. And therefore, this 50 I am reducing is towards repayment of loan, and accordingly, my capital gains would be 150. Is what? This is a competition of the SSE, yeah, students, by the way. This is the competition of the SSE 150. What do you think? Is this competition correct?
No.
And why you say so, students?
So technically, there is he has taken loan for his own personal purpose, and henceforth he has mortgaged that specific asset. So he cannot claim that it is for the specific capital asset he had taken the loan for the improving it. Rather, if that would be the case, then of course, if he has taken as a part of cost of improvement, then we could justify it. Else, it is not justified.
That is the case. So may I just put it through this way? When you talk about improvement from whose? Who is the assessee? Assessee is Mr. A. Tell me in this context, when the assessee got the asset, who is assessee? Assessee is Mr. A. On whose you are doing the assessment, na? In whose hand you are doing the assessment? So the improvement has to be seen from that assessee's point of view. In whose hand you are doing the assessment? And tell me, when the assessee acquired the asset or got the asset, who is assessee? Mr. A in this case. At that point of time, what was the kind of the asset? So when you talk about improvement has to be seen when the assessee, in whose hand you are doing the assessment, when that assessee got the asset, at that point of time, what was the status of that asset? What was the status of his right? Did he had an absolute right when he got the asset? Did he had the full right over the asset? Originally, yes. In between what he did, in between he has diluted his right by doing the mortgage and diluted the right. And after repaying the loan, he has recouped back. Recoup means he has got the same right which he already had when he acquired. And therefore, there is no improvement as far as the right is concerned. Because who is assessee? Mr. A is assessee. And Mr. A, the assessee, when he got the asset, at that time, what was his right? Compare that now. That becomes the focal point. So, did he improve upon the right? No. So, what he had originally is what he is selling right now. And therefore, what he had originally, the right that he had originally is the same right that he is selling it now. Therefore, there is no improvement. Yes, in between, what happened was he happened to take a loan, he happened to dilute his right, and by repaying the loan, he has just square up his dilution. He just squared up by repayment. And therefore, the conclusion is there is no improvement of the right. Just take a note of it. Just I'll give you the sentence, and then I have to take you to the next case now. Quickly, students, just very quickly. Have you copied down this example? I hope that.
Yes, yes.
Perfect. Just students, write below this. The capital asset transferred. The capital asset transferred is the capital asset transferred is accessible in the hands of Mr. A in the hands of Mr. A in whose hands whether there was any improvement whether there was any improvement in rights whether there was any improvement in rights is what needs to be tested is what needs to be tested, full stop. When he acquired the asset when he acquired the asset comma he had the same right he had the same right he had the same right at which he transferred the asset he transferred the asset, full stop. Therefore there is no improvement there is no improvement in rights there is no improvement in rights at these 2 point of time at these 2 point of time, full stop. Next line, right, students. The subsequent mortgage created by him and its repayment before the actual transfer before the actual transfer has only recouped recouped means regained recouped his right to the original position recouped his right to original position and hence there is no improvement there is no improvement. Okay, students. Now just bear it in mind, students, these things. Next judgment, students, is are. 'Are' 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 Arunachalam Supreme Court. R, huh? This is R. Arunachalam Supreme Court. Now, students, father has acquired the asset, say rupees 100. Okay? Thereafter, father took loan of rupees, say 30 by mortgaging the asset. Father has taken the loan, students, by mortgaging the asset. Okay? After that, students, again the same thing. Son inherited. Son inherited the house property, students. For whatever be the reason, say on the account of death of the father, for whatever be the reason, section 70 came into picture here. Okay? Thereafter, students, son repaid the loan. And finally, son has transferred the capital asset. Whatever be the amount, say 300. Fine, students. So the question is ready. If you have copied on this, all these are there in the module. So the notes I've already given. It's not that these are not there in the module. All are the case laws that we are doing is from the module also. So now, students, tell me the solution in this case.
Sir, sir, what
Yes,
I
Ravi.
think, sir, yes, what I think when son inherited the house property, the title got degraded because when father took the loan, it was degraded from the earlier position, and now he restored the title. So in that case, he has made the investment for improvement purpose. So in that case, it should be allowed.
Perfect. Very good, Rakane. Excellent. And that exactly is the position, students. So, as who is SSC by the way here? Son is SSC. What I have told you, SSCs in their hands the assessment is done. When the SSC acquired the asset, what was his in his hand? What kind of right he had? Did he had the absolute right over the property? No, he had a limited right. Why? Because the property was already mortgaged because of that loan. So that limited right is what the SSC inherited. Who is the SSC? The son is the SSC. And that limited right he improved by repayment of loan. He improved by repayment of loan, and therefore that repayment that the SSC has done will be considered as the cost of improvement, and that will be allowed to you as deduction. Is that point clear to all of you students?
Sir, I have a query.
Okay.
Like, sir, even though see, assets is being inherited as compared to the liabilities is also inherited, right? So on that angle, sir, father's whole right actually got transferred to son. If we look into that angle, are you getting my point? Yeah. So that's why I was like, how limited right in that sense?
No
I got your
liability. Yeah, that is true. The liability has diluted his right as far as the asset is concerned. The right gets diluted because of the liability factor, isn't it? So the fact that it's a net asset that he got, not the gross asset, primarily. So his inheritance was the net asset part, primarily, and then by repaying, he made it as a gross asset. So did it improve from net asset to gross asset? Yes.
Okay, so we are just having a very, eagle's eye upon the right perspective here.
Yes, of the assessee in whose hand you are doing the assessment. And who is the assessee in whose hand you are doing the assessment? The son. So what he inherited was a net asset. After repaying the loan, it became a gross asset.
Got it, sir.
Sir,
Okay.
sir, I would like to add some points, sir.
Please, sir.
Like, sir, when the son inherited the property, on the property there was a charge.
Yeah,
So for that, the actual right degraded from that charge. So for removing that charge, he has to pay
very true.
to gain the absolute right.
Perfect. So when you take a loan, that is exactly is the point, students. So when you take a loan, students, there are two rights that is created. One is of the mortgager's right, another is the mortgagee's right. Isn't it? Mortgager's right versus mortgagee's right. And therefore, when you repay the loan, you become the absolute owner. And that is what probably now you are the absolute owner of that particular property. So when he actually inherited, and as Kanaya said, there was a charge which was existing. Because of that charge, the right was split. Family, mortgagers, mortgagees, isn't it? When you repay the loan, the charge probably ended on repayment. You got the absolute right. I hope that all of you are clear with this one now, students.
Sir, I need a clarification.
Yes, Yogendra.
Sir, actually, the land got mortgaged, the property which house property got mortgaged,
Yes.
and when it was transferred to son, it was like mortgaged property is got, and for that entitling for absolute ownership, he repaid the loan. But sir, I need a clarification that as there is no physical change of house property, I think it is not like to consider as improvement. Can I think it should be added to the cost of acquisition because after repayment only he became absolute owner, right, sir?
Yes.
I need a clarification on this.
No, again, we come back to the last part. Again, if you can just come back so that I understand what you have understood your query, I will formulate
Sir,
it.
actually, when he was inherited from father to son, when was the property transferred, it
Perfect.
was mortgaged property,
Yes, yes.
and for his absolute ownership, he was repaid the loan.
Perfect.
So I think the repayment of loan should be his included in cost of acquisition, other than in the cost of improvement, because there is no physical change
That's
of
true. You,
improvement.
you may add to this cost of acquisition now. This particular will not materialize. So, but the point was that whether what you are saying, sir, whether we should take this in the part of the cost of acquisition or maybe the improvement, we don't debate dispute on that particular part, whether it could be added or not. But the important part is that whether it will be in the overall scheme of things where you get two deductions, cost of acquisition or cost of improvement. Whether this deduction would be allowed. Like this Arunachalam and the earlier case law was Yogendra VSMR Jagdish Chandran. VSMR Jagdish Chandran said that repayment of loan, no deduction. Whether in the form of acquisition or whether in the form of improvement, no deduction. Arunachalam, probably, the repayment of loan is happening here also. But the catch point was the right which I inherited. Was it an absolute right? And the answer was no. And that being the case, a repayment that happened of the loan by the SSC, who is the son, that repayment essentially probably has improved upon the right. Yes, you can say the physical asset on that theory note, you will say, sir, that could be reduced in that context. You may say so, and we can reduce it, or we may consider this as a part of the cost of acquisition for the son, technically speaking. Or you may target this to be a case of an improvement. So the
Yeah,
point
sir,
about
because while we have a format of computation, so while computing, that we should include in cost of acquisition, right? So that
yeah, yeah.
need I confirmation. Yeah,
Yes, you can do that.
yeah,
And
sir.
now the fact that the indexation aspect has also gone, so would not materially will matter, but yes, for real estate, the indexation option is there in that regard. But yeah, so should just quickly take a note so that we can just take a further this thing. I just need to do the tax rates also, special tax rate quickly. Just quickly, students, take a note. In this particular case, I hope that you have copied this case study, yeah? All of you. If not, then shouldn't
Yes,
just
sir.
keep this much of space left and you can see later on in the recording part. But just try to take a note quickly, right? In the present case, in the present case, The SSC son SSC son has inherited from his father from his father a limited right from his father a limited right since since his father has already mortgaged the property has already mortgaged the property on its acquisition. No, sorry. Uh, uh, has already mortgaged the property before the inheritance. Full stop. By repayment of the loan, by repayment of the loan, the son has the son has removed the encumbrance, remove the remove the encumbrance on the property. Remove the encumbrance on the property and hence shall be allowed as deduction. Shall be allowed as deduction in computation of capital gains. Now, students, very quickly, we need to just move past. So, students, now let's look upon to the rate of taxes. Because obviously, we are preparing, because next particular class, students will be doing it very integrated approach. Huh? Next session, we will have a very integrated approach, and therefore, I'm preparing till the tax rate. We'll do a lot of solving again on that, because the all that section 82 rollback, everything will come. Now, students, can you see this one in this context? Now, students, this rate of tax, long-term capital gains. Now, students, as such, 190, there are three special rate, you all know. In the new income tax law, there is three special rate. Which are the special rate for capital gains? 196, that is STCG. 197, LTCG.
LTC.
And 198 is also LTCG. Perfect, students. Now, what about this STCG and this LTCG? They are relatable on transfer of equity shares, on RSC. RSC is recognized stock exchange, on which STD is paid. So, transfer of equity shares on RSC, that is recognized stock exchange. LTCG, this rate is 20%. This LTCG, STCG is 20%, LTCG is 12.5%. But in excess of 1.25 lakhs. All of you are aware of that, isn't it? Now, if a real estate is sold, what is the period of holding to be considered to understand it is long term or short term for the real estate? First, tell me that. The period of holding. How do I know that the real estate is a long term or a short term capital asset? What should be the period of holding that I should consider it?
I
Sir,
think
from
it's
date of
24.
acquisition to date of transfer.
Yeah, date of
Or else
transfer.
if it was inherited, then cost of date of acquisition of previous owner.
Yeah, yeah, true. And no, like in terms of the number of months, how does it
Sir,
this short term and
24
long term
months.
number of
Like
months?
24 months, sir. More than 24 months.
24 months. So students, now again I repeat this particular part. Only for that listed securities and the units of UTI and the zero coupon bond, we have got 12 months threshold. After that, for all the remaining asset, we have a 24 months threshold. And for slum sale, only one specific case. Slum sale, what is the capital asset which is transferred? Business undertaking. For that business undertaking which has been transferred as a slum sale, for that there is a 36 months. I hope that all of you are clear with this one, isn't it? Now, tell me, if it is a real estate, therefore, should real estate will go to 24 months threshold. Real estate, if I transfer to decide whether it is a long term or short term, 24 months threshold is what has to be seen. If it is more than 24 months, students, if it is more than 24 months, then tell you students, if it is more than 24 months, then it is a long term. And if it is long term, students, so accordingly, it will be at 12.5%. For that, more than 24 months, students. Okay? In excess of 24 months. Up to 24 months, short term. Short term will go at what rate? Short term will go at what rate? Now that will depend upon the person you are. If you are individual HUF, AOP and VOI, then for that there is a slab rate. And please understand, students, even the slab rate depends upon if there's a default tax regime, then the slab rate is different. As compared to the old regime, the slab rates are different. So a short-term capital gains on the real estate transfer, that will depend upon the person that they are, because if you are an individual HUF AOP BOI, then then it is a slab rate that will come into play. Depending upon which regime you are in, the slab rate only will come into play. But the slab rates are different depending upon which regime that you are. And if you are a company, then your normal rate, 30%, or for that matter, if you are in that alternate tax regime, it becomes a 22%. We'll see those chapters separately. But that is what I just wanted to tell you. But if the real estate is a long-term capital asset, resulting into a long-term capital gains, in that particular case, students, what is the rate? Rate would be 197, 12.5%. I hope that this point is well taken by all of you students. Now, there are some important particular points which I want to discuss with all of you students. There is a rebate, students. Remember in old section that you are doing, it was what? It was section 87A. Remember that?
Yes, sir.
In old section, it was 87A. In the new set of sections, students, it is 156.
156.
156 students, can you confirm that?
Yes, sir,
Yes, sir.
156.
Perfect, students. Very good. Now, in the point which I just wanted to ask to all of you is that whether you get a rebate, students, whether you get a rebate from these special rate students in this case of tax 196,
No,
197, 198.
no, no, sir, we don't get.
Sir, what I think, sir, like if you are below the basic exemption limit, means 4 lakh, in in that situation, up to 4 lakh, you will get the rebate. After that,
No, that is a separate thing. That is the Kanaya, that is my second point. What you're trying to
okay,
say, Kanaya, is that can we adjust our unabsorbed basic exemption limit against the income chargeable to special
right,
rate under
right,
196, 197, 198. That will come. That is my second question. Right now is my rebate. Rebate you get it from tax. So
hmm,
from a tax amount that you have calculated, you get rebate. Generally you get rebate, yes. But
yes,
my next question is, do you get a rebate in respect of the special rate of tax under 196, 197, 198?
no, sir,
Do you get it or not?
Under the new scheme, no sir. But
And
under the old scheme, yes.
yes, that is true. That exactly is the point, students. So just students, first thing and first, I have two things only the special point because now since students you have to do the calculation. I'm preparing you for the practicals now. But we cannot jump into the practicals without having our tools ready. These are the tools that you need to keep you ready. So rebate under 156, old is 87A, so that you can relate it. So it depends upon students in this rebate under what's in respect of, I'm writing, students, please take a note of this. In respect of rebate under section. Just in respect of special rate of tax under section 196, 197 and 198, sorry, and 198. So students, as Kanaya said, it will depend. If you are under the default tax regime, what is default tax regime? Alternate tax regime. Default tax regime, in this case, the answer is no, not available. Not available for the special tax. Not available for the special tax. And if it is a normal tax, for which you have to opt out, students, then rebate available. Okay, all these are there in the notes, by the way, but I'm just making this thing because I need your focus to be on particular issue because this is how you are going to now solve the question. Typical things. Have you copied on this one, students?
Yes, yes, sir.
The second part, students, is about the adjustment of unabsorbed basic exemption limit. Unabsorbed basic exemption limit. Students, are you aware of some surcharge part? There is a limit of surcharge on capital gains and
Yes,
dividend. Okay,
yes,
very good.
yes.
Very good. So that note, I'm not giving it to you. I think that is already covered. So therefore, just stick on this particular part now. Adjustment of these are some special points. I think that surcharge you already have covered in the earlier class, if that be the case. So that is good. Adjustment of unabsorbed basic exemption limit, students. Will you understand what it is? Say, for example, students, I am under a default scheme. In default scheme, what is the basic exemption limit? 4 lakhs. Isn't it? 4 lakhs is a basic exemption limit in a default scheme, which is the alternate scheme. And under, if I opt out, then it is 2.5 lakhs. If you are a senior citizen, then it may increase to 3. Super senior citizen, 5 lakhs. Isn't it? Default tax, it is only 4 lakhs. Do you all agree?
Yes,
Supposingly, students, I am in a default scheme. I have a house property income of say 2 lakhs. and I have got this LTCG from the transfer of some real estate of say 3 lakhs. 3 lakhs. Okay. And I'm in the default scheme. So what happens now in this regard, students? In this case, what is the unabsorbed basically exemption bit? Do you know? You'll say, sir, what is unabsorbed but? How do you define the term unabsorbed? Let me in fact tell you. Many students would be wondering, what do you mean by unabsorbed? So I'll just also tell you, your basic emission limit, BEL, minus the normal income. Normal income is for which there is no special rate. That is the unabsorbed part. Okay? Basic emission limit minus the normal income. So this is your unabsorbed. So now you tell me 4 lakhs is the unabsorbed basic emission limit. 2 lakhs was my house property income. 3 lakhs is my LTCG tax under 197. Now therefore from 4 lakhs I will reduce the normal income of 2. How much is the unabsorbed one? Unabsorbed is 2 lakhs. Now how much is the LTCG? LTCG is 3 lakhs, which is supposed to be charged under 197. Question is that whether this 3 lakh can that be adjusted against 2 lakhs? Answer is yes. Answer is yes, students. You can adjust it, and therefore after adjustment tell me how much is the balance LTCG under 197? 1 lakh, and therefore on 1 lakh you will apply 12.5%. The question is whether this adjustment that we are talking about it is available in both the scheme. Both the scheme means whether it is in a default, both the regime, whether it is default or normal. I hope that all of you are clear with this one, students. Every one of you. Fine?
Sir, were you talking about surcharge upon the total income?
Yeah.
Okay.
So students, this is what the theory is, and now I've already created a chart, so I'm not touching upon these things again. Now students, let's have a look. Cost inflation index and land building comparison. Students, I told you every one of you are excited. Excited about what? Sir, what about the indexation? Up till now, indexation has not come in interest here. We remember that we did indexation right from day one. The reason being, students, now the indexation as a concept has been out. It is applicable only, students, only in a particular case. And that too as an option, not an obligation. And therefore, that is the only option on which the indexation can be considered. Other than that, indexation concept is a yesteryear concept, not the current year concept. Let's have a look. To whom, if at all indexation you are thinking about it, the assessee needs to be an eligible assessee. Now see the slide. Resident individual or a resident HUF, that too resident. Okay. By the way, students, that rebate and that unabsorbed basic emission limit, can you just write because you are already in your notes? Can you just write that? This unabsorbed basic emission limit and the unabsorbed and the rebate, where rebate is applicable probably in the one case, na, in the normal old tax regime. So rebate or adjustment of unabsorbed basic emission limit, that is available only to the SSE, to the resident. Students, only to the resident. So if you are a resident, only then you are eligible for those particular adjustments, if at all available. Same way over here also that you are reading right now, eligible SSE, resident individual or resident HUF. After that, assets, long-term capital asset being land or building or both. So only for this asset, and that too, date condition you have to satisfy. This asset you should have purchased, students, before 23rd July 2024. Just check in your case of your parents would have purchased it. They would have this option. Now tomorrow, people, students, you people would be earning, and then you may acquire one house property. You will not then get this option because your date of acquisition should be before 23rd July 2024. Yes, your parents may have acquired those house property before this date. You may inherit those properties later. At that time, when you will do your computation, at that time, when you do the computation, yes, you will say that I will have that particular option. That is possible, but not in the case of your acquisition that you will do somewhere now post your qualification. At that point of time, you will not have this option. So the option is available only for these assets which are acquired before 23rd July 2024. Income tax on the unindexed LTCG. So therefore, students, there are two options I told you in this case. So what is the true option? A or B, whichever is lower. Obviously, SSE will take the option. Na? As an SSE, what is the option that is take? Where his liability would be lower? So without indexation, 12.5%, he will see that. Or with indexation, applying CII and having the inflated cost and reducing that inflated cost, whatever is the capital gains, that capital gains will be at 20%. And then you will see whichever is a lower cost, that lower particular this thing, that lower is a tax liability. So this is what it is, students, in this regard. I hope that all of you are clear with this one. Okay, so this is one thing that you should just remember this particular part. So remember, students, indexation operates only for tax comparison stage. So when you compute your tax, now be careful. This is also one of the error. Students, can you see this? When you compute a total income, will you have your capital gains shown in the outer column? When you are computing your total income, will you have your capital gains in the outer column? Which amount? Indexed amount or without indexed amount? Index amount or without index amount? What is that you're going to have? Say I purchased a land in 2010. I'm selling the land now, 2026, 27. Now, obviously, that option is available to me. And the indexed figure results in a lower particular tax liability. The index cost results into lower capital gains. Because of that lower capital gains, there was a lower tax liability even at 20%. My question to all of you students over here is that my question to all of you students over here is this, that in my computation of total income, for tax liability is the second step. First step is total income computation. In my CG, will I show the indexed capital gain or without indexed capital gain? So, thumb rule, students, this note becomes very important then. Thumb rule. As far as the computation goes, computation does not recognize the indexation concept now. Computation, students, does not recognize the indexation concept. So that will be students, that will be a non-indexed amount. Means simply full value of consideration, less expenses of transfer, cost of acquisition. That's it. And capital gains. That capital gains is a long-term capital gains. But without indexation, it will enter into your in your total income. When you calculate your tax liability, at that time, the amount which is included in your total income, that is there. That will be compared with what? That will be compared with what, Shruts? With the index capital gains. Okay. On that index capital gains, 20%. And without index capital gains, 12.5%. You'll see which is lower amount. That lower amount will be the tax liability. Is that point clear to all of you students? I want confirmation from every one of you.
No, sir, not clear.
So just pay
Can you
attention.
repeat once again, sir?
Yeah, I'll just give an example directly then. In this case, just pay attention here. Supposing the full value of consideration is say 100, cost is say 30. Index cost of acquisition, students, assuming I have done the CII, that becomes say 60. Okay. Now there is a two things herein. What are the two things? So this is what you already know. Now when you compute a total income, computation of total income, okay, you'll have the heads of income, na? House property, PGBP, and then capital gains. When you calculate capital gains, and this is say a long term, obviously when you talk about indexation, it means there is a long term capital gains. LTCA, na? The asset has to be LTCA. Otherwise, the question of indexation will never arise. Now, when you talk about capital gains here, this always would be full value of consideration minus cost, not index cost of acquisition. So this always would be 70. This always would be 70. Means minus the cost, not the index cost of acquisition. Are you getting this one? And accordingly, you will get your total income. And accordingly, you will get what? Your total income. So now you have your total income Shruti, in this regard. So in your total income, what I told you, in your total income, you will have a non-index capital gains. This is what you need to write. Right next to that. I have written this total income. I hope that you are copying this format. So in your total income, please write, you will have non-indexed capital gains. So this is the format. These are the small things, students. Students ignore this thing and they make an error out of it. So therefore, in your total income, this would be the non-indexed amount. Is it clear? Now, tax liability. Tax liability. Now, when you calculate a tax liability, students over here. Now tell me, when you calculate a tax liability, students over here, please tell me, how do you go about it? So tax liability computation, students, when you do this, tell me, now you'll have an option. Option of what? On 70 at 12.5%, or what? On 40 at 20%. Whichever is lower. Tax liability on what? On the LTCG. This is the option. Is this option available to all the long-term capital gains? Tell me, is this option available to all the long-term capital gains? For all the long-term capital gains, are you going to do this?
No, sir. Only for land and building.
Land and building, and that too, which has been acquired before 23rd July
23rd July
2024.
2024.
Very good. So now, Shruti, can you tell me this answer? This, any case, if we got 8, what about the 70 at 12.5%? How much is the amount?
8.75, sir.
8.75. Okay. So now, students, you can see this. When it comes to tax liability, you will select 8. In your tax liability, how much amount you are going to select? 8. This is the tax liability comparison that you do. But did you realize one thing? In your total income, it is 70 that is reflected. Whereas in your tax liability, it is 8 that goes. And that 8 is on 40 at 20%. This is what you have to do. Then one thing that will come, sir, then what is the use of this 70? Isn't it? One thing that may come to your mind, then sir, capital gain should have been written as 40. No. They are doing it deliberately, students. Can anyone tell me what is the reason why they don't want the indexed capital gains in the total income? What could be the reason, students, by the way?
Maybe due to maintain the specific format.
Format. Other than that, we just have discussed
Sir,
some.
our actual like to know actual income generated, like our actual gain generated.
Okay. Okay. And what else? We just have.
Sir, it may be like that they wanted to show the income in a higher bracket, so that surcharge and other
Surcharge is
sales
the
and the
game. Very good. By having a non-indexed amount, now think of it, students. What happens? If this would have been an index amount, tell me what would have happened? What would have been the capital gains? Capital gains would have been 40. Now, what is this? This is a non-indexed amount. So, by having a non-indexed amount, automatically your total income increases now. And there would be a possibility, a very high possibility, that this total income may cross 50 lakhs. And you are entering the surcharge era. If the index capital gains would have been there, your total income may not have crossed 50 lakhs. And there may not have been the surcharge on tax. This is one of the reason why they don't want you to put. One of the reason what you are saying, students, that is also fine. But this is one of the reason from the revenue point of view. I'm talking from the revenue now. One of the reason why they are putting the non-indexed amount in the capital gains. Now, can you remember this thing? This now I hope that by virtue of the logic, you will never ever forget it, and you will never ever make this error. I hope that this point is well taken by all of you.
Yes, sir.
Perfect, students. So, Dhruv, this is what it is, the calculation. I hope that the example is also been copied by you, all of you. Now, students, just a last, I think this is one thing we have done already. So, now what is left? Just a second. Okay. So, we are done with this particular part, students. Now, with that, students, I think what else? Tax rates are through, including the CII. Yeah. This CII, by the way, still those who want to know the CII, this list has been given. You don't have to buy at CII, by the way. Okay, those will be given to you in the question, so you don't have to worry much on that. And yeah, those this all that things students. 156 we discussed just now. What is that? Rebate. So that already discussion that I had, but revise it through my chart. I have simplified it. The tax regime. What are the tax rates? Normal tax rate in the default tax regime already has been given to you. Set off and carry forward of losses, students, we'll do it separately in that chapter. We don't have to worry on this. Now, students, in the next class, students, we will be entering into the real estate transaction in terms of the. You remember there is stamp duty value, stamp duty valuation. So, in the next class, we will do those stamp duty valuation part, and then we will also do the exemptions part. Stamp duty, exemptions, and then practical questions. We'll done with that, and then the last particular area that will be there would be the partnership assessment. Partnership assessment. This is how, students, you will revise your entire capital gains. Now see how capital gains becomes meaningful. Otherwise, if you read individually without an integrated approach, then every particular individual provision becomes a challenge. So this sort of an integration, students, is what is required. See, all the tax rate is done. And now we are done with the tax rate so that we could now start solving the question. So the next class, students, what we will do, that exemption part, obviously we will have to solve the question, so that we need to do the application. And then while we solve, we'll do an integrated approach of all that we have learned. And that exactly will be the beauty of this. So today we did the students the business restructuring. In that, students, demerger is what we have touched upon, and also the other things like the case of the amalgamation, demerger, that 25% limit. Also, we discussed in today's class that particular part of the redemption of preference shares, conversion of preference shares. As far as the conversion is concerned, there is a section 70 exemption applicable. And then after that, we did the demerger. In the demerger, students, the concept of demerger, and then see the practicals become so easy. But be careful when you read the question. In the demerger question, students, that question will be solved. Although the question was about in the hands of the shareholder, what is the capital gains implication for receipt of the shares of the resulting company. But instead of being capital gains, if they would have told you what is the tax implication in the hands of the shareholder on the receipt of what? On the receipt of the shares of the resulting company, then what is that you're going to write? Not only your CG, also your IFOS. So we did that, and then we moved to the real estate transaction. In the real estate transaction, we again recap the entire particular provision. So it's actually a revision thing that we actually are getting it, opportunity. The way also this we get the opportunity in PGUP, even today, format is getting revised. Okay, by the way, students, the last torture point. Students, just today class, interest on enhanced compensation is taxable. Is taxable in which head? IFOs. And that too on receipt basis. Receipt basis. In PGBP, anywhere you got any taxability on receipt basis? While we were discussing PGBP, was there any taxability which was there on receipt basis? I told you that I will ensure to end the class today and we'll have a torture question. This is one. Can you recall?
Sir, sir, when we receive enhanced compensation, then in that case, the tax liability on the receipt basis,
Okay. And
enhanced compensation, and
okay, so just find it out. I want the answer by next class. So at least next 2 or 3 days. I want the cases of, so your homework friends is ready. So homework is, which were the cases that we discussed? In fact, we did where the in PGBP the tax was on receipt basis, irrespective of your method of accounting. Irrespective of your method of accounting. In that case, so you may have a mercantile system of accounting. We don't care. We will tax you on receipt basis. Which one?
It's I remember.
Yeah,
It's
what is it?
a bad debt written off which is being received.
Okay, that is one. Apart from that, so create a list. That is what I'll suggest to all of you. Okay, that is one. Yeah, I fully agree. Bad debts recovered. We may say yes on receipt. Whenever the recovery has happened, it is taxable in that year. Apart from that, okay. Just see if you can create the list. Fine, students.
sir,
Good.
sir, can I ask a question, sir?
Yeah, yeah.
Sir, we have discussed about the improvement, right? So, sir, in that case, we have only discussed about the right restoration and whether a right is there or not in case of cost of improvement.
Yeah.
So, sir, what are the other areas which may or would come under cost of improvement, sir?
A normal case, like for example, building. For example, supposing I had a building. Okay, and that is a normal case. Like I had a two-story building. Okay, thereafter I made a three-story. One more story was added. So I acquired a two-story building. Okay, and then I made it three-story. So what it will be now? Original acquisition was a two-story building. Then I improved one more story on that. So that would be the improvement.
Okay,
That is that's a simple example. This is a technical and complex example. That's the reason why this. Therefore, there was the case clause on that.
okay.
Okay.
Thank you, sir.
Okay. So
Sir,
students,
and
look. Yeah. Please say,
sir,
Yogendra.
one clarification.
Yeah. Yeah.
Actually, regarding rural agriculture land,
Uh-huh.
sir, if we have a rural agriculture land and presently the land value has been increasing, somehow the person was committed to sell it, but before that he want to convert into non-agriculture land
Okay.
through NALA process, like conversion of
Yeah.
land
Yeah.
agriculture to non-agriculture. So in that he incurs NALA charges, sir. In case if we take a real estate business, they will consider as an expense. But if we take as individual person, can we claim that in cost of improvement, sir?
In the case of if we want to convert, generally I'll tell you when they generally do the conversion, these kind of a conversion, generally these are for the real estate business purpose, primarily. Otherwise, they will not do the conversion. So generally, it is a business purpose. So business, yes, it will be. Now, if it is a case of, say, for example, no, sir, it is not a business. This is a case of a conversion only. So yes, if supposingly by a rural to an urban, the question arises: does this fetch an enhanced particular value as far as your right is concerned from rural to agricultural urban from rural agricultural land to an urban one, and for that the conversion you have to incur certain say statutory charges, sometimes other than statutory charges. We just have
Sir,
to see, yeah.
if we are like what you said, that rural to urban, if it becomes again the distance matters
Yeah.
regarding of area of population, but
Yes.
in rural area only,
Yeah, yeah.
just within the limits of out of the
Yes, yes.
limits, in rural
That's true.
agriculture land they are converting. And
That's true.
also, sir, this one, and also the point is, once it was converted into non-agriculture asset, it will be considered as like capital asset, right, sir?
True. Very true. If it is
Yeah.
a
So
what?
then from like after that, after 2 years or 3 years, it was transferred such land. If for this, if we want to calculate period of holding, should we have to take from the date of for which it was converted into non-agricultural land or from prior?
The period of holding, in this case, the question that therefore is, now let me, if I put across, I formulate the question of Yogendra and let me put across this one because I think I'll formulate it and all of you try to give me the answer by the next. I'll formulate his question now properly. His question is that, sir, the period of holding which was to be calculated is the period of holding to be calculated from the date when the asset became the capital asset, which means when it became the urban agricultural land, or it should be calculated from the date when I have originally acquired the asset, which is rural agricultural land. So from which date should I be calculating? Should I be calculating the period of holding? So his question is from the date when the urban agricultural land, when the conversion has taken place and it became a capital asset because it became an urban agricultural land, from that date till the date of transfer is a period of holding, or from the date when I originally acquired the rural agricultural land, from that date till that date. So this is the period of holding. Just think over it, students, and maybe you can just be ready with your answers. Next particular class at the very outset, we'll just try to address this thing. I've already have touched upon in a different way, but let me see if you all can. Okay.
Sir, actually I got it the point, but need a confirmation. That's all.
Yeah, I don't know. This is a very conceptual point actually, because I think this particular point was also been discussed in the earlier class. So if I just wanted to, this needs to be deliberated. If I just
Uh,
straight away answer it, na,
Sir,
so it will
actually
be.
I thought from date of converting, like from date of converting into capital asset, because we generally talk about the period of holding for only for capital asset.
Yeah,
So deliberately I think so, but
yeah.
I need a confirmation.
If suppose if it is only for confirmation purpose, that's a different thing. But this is the answer also. But
Sir,
nevertheless,
may I tell you, sir?
yeah, can I say?
Yes. So in this case, I think sir, there would be two type of income.
Yeah.
First is when conversion took place. When conversion took place, so from the date of holding the agricultural land, it would be treated as agriculture income. That would be exempt, and from the date of conversion to the date of actual transfer, that would be considered as capital gain or business or profession income based on the uh, SSC's profile.
And the period of holding would be from which date to which date?
From the date of actual conversion, sir. Because
Ra-
from earlier date, it was not a capital asset. It was only agricultural land.
Yes. What about you, Radha?
Sir, I think a property definition was being specifically told by you that it is the exclusive right. So, right of that particular land was on the date on which he had acquired that agricultural land, irrespective of rural or urban. So, that's what my ideology is.
So was he holding the period of holding as what? As a stock and trade or as a capital asset?
Um, so, it is as a capital asset, I guess, but it was not under the purview of capital asset when it was rural agricultural land specifically.
Therefore, when we talk
Right.
about the period of holding particular part, period of
From the date
holding
of
as a capital asset.
right.
So therefore, if you remember from capital asset into stock in trade when there is a conversion, just at that point of time also
Yes.
I told, when the capital asset is converted into a stock in trade and we don't charge the capital gains at the time of conversion, but we charge the capital gains subsequently when the stock in trade is sold. But the question that I have framed at that point of time also was that the period of holding when we compute, you have to consider the period of holding as a capital asset. So only for that limited particular point of time that the period of holding needs to be computed for the held as a capital asset. So this is what should always be.
So, sir, I was looking on the right perspective. The right he had on that particular asset earlier also.
Yeah, right is
So,
there. But because of the different heads, we need to also respect that
correct.
thin line of demarcation. Like Kanaya said, na, agricultural income will also be there. Like we have got capital gains, we also have got dividend income. So we need to respect that border that comes in between.
Okay, that means when it was converted, that only period of holding from there we will
Only
pay.
from that period. Only that. Yogendra got it?
Sir. Yeah, first I thought starting the same, but need a confirmation.
Yeah. Because we discussed actually that, no? So I just wanted the opportunity also to give it to students. Actually, you got
Sir,
it. Yeah.
sir, I think it's 9:35 and we have to wind up the session.
Yeah. I think we'll wind up. Okay. So see you
Sir,
then.
last
Students,
one.
if you have any, yes.
Sir, that prior we discussed, conversion charges are included in cost of improvements or not, sir? Just
Yeah, that
I
will be.
need that.
That will be. That will be.
Yeah. Okay, sir. Thank you.
Okay. Yeah. So bye. Take care.
Yeah.
Good night,
Bye,
students.
sir. Good night, sir.
Good night. Good night. Good
Good
night.
night, sir.
Good night. Good night. संकेत जी बंद कर देते हैं संकेत जी बंद कर देते हैं थैंक यू गुड नाइट